Okay, so our class is being recorded now. Good morning, everyone. Let's start the class. So yesterday, we were able to look at the our syllabus, and we discovered that the part of the syllabus that has the highest weight is this advanced investment appraiser. So this advanced investment appraiser is what we're going to start with today. So I listed out some topics that we're going to cover in this lecture. Then later, I will now show us additional topic in order not to make it too clumsy or not to make it scary. So we shall finish all this one, then we shall move over to other areas of the syllabus. So now, advanced investment appraiser is the largest or is the one that has the highest mark. So this one, I think, is it 30% or 35%? I can't be too sure. But we looked at the syllabus yesterday and we saw that this advanced investment appraisal technique is the one that has the largest weight. Okay. So if you can know it very well and know others as well, you know that the sky is below the limit for you in that exam. So now, what is advanced investment appraisal? In your when you were in the other stage, maybe when you were in skills, okay, when you were in skills, you have looked at investment appraiser techniques before. So those ones you are not looking at a discounted method. But now with this advanced investment appraiser technique, we are going to be looking at discounted cash flows or discounting of cash flows, the techniques of discounting cash flows, because we know what we call time value of money. Cash flows that will come to you in the future, you need to know the value of those cash flow in today's term. You can't just say, okay, I'm expecting 500,000 next week. I'm expecting 1 million next year. I'm expecting 3 million next year. You know, you need to know what is the value of that money you are expecting in those future period. What is the value of that money today? You can't just record in your books that we are expecting so and so money. You need to discount it to present value to know the actual worth of that money you are going to get in the future. So that is where the advanced investment appraiser techniques come in. So now let's now look at it. Under the advanced investment appraiser technique, you have to deal with discounting of cash flows. But when we're in PM level, we're not discounting cash flows and everything. We're just working with data as it is. Okay. But now you are a step ahead. So you need to now talk about how to discount those cash flows that are coming in the future, how to discount them to present value. Now, let's continue. Discounting cash flow techniques are investment appraiser techniques which take into account both the time value of money and also total profitability over the project's life. It is therefore superior to both the accounting rate of return and the payback methods of investment appraisal. So it is superior because it takes into consideration the time value of money and also total profitability over the project life. Now, these are the methods of this advanced investment appraiser. Under this discounting method techniques, we are going to learn what we call the net present value. We're going to learn what we call internal rate of return. We're going to learn what we call modified internal rate of return. We're going to learn what we call discounted payback period. We're going to learn duration. We're going to learn profitability index. We're going to learn adjusted present value and so on and so forth. Now, the assumed objective is to maximize shareholders' wealth. When you understand how to really give the management the right information that they need, okay, it's going to help them in planning. It's going to also help them to be able to maximize the wealth of the company. Okay, so quickly, let's look at what net present value is. Before I look at them briefly, then we'll now go and look at them in-depthly, because this net present value, when you have idea of this net present value or idea of all these discounted method, is also very useful to you when you are doing case study. Okay, so I always advise people that are going to sit for case study to also, even if they don't have SFM to write anymore, but because they need the knowledge of SFM, they need to refresh their mind about what they were taught in SFM. They need to still come back and join the SFM class especially when we are giving free classes like this. You don't need to pay separate money for each of the classes. Just come and attend it and get knowledge for it. So now, the net present value of a project, okay, is the value obtained by discounting all the cash flows and inflows at a chosen target rate of return or cost of capital and taking the net total. So now under net present value, when you have a project you want to embark on, that project, you need to invest money in it. You need to invest money. So that investment is what we call cash outflow. You need to invest that money in it. They call it cash outflow. Then from that project, you are expecting that inflows should be coming to you in the future. So that is what come about cash inflows. So under net present value, we have two types of cash flows. We have the investment stage cash flows, and we have the return phase cash flows. So here, under net present value of the net present value of a project is the value obtained by discounting all the cash outflows, which is the investment stage, and inflows at the chosen target rate of return or cost of capital. All right, and taking the net total. This is the present value of the inflows minus the present value of the outflows. So when we are in the skill stage, they tell us that NPV equal to present value of future cash flows minus initial investment. However, you must also know that this initial investment is also a cash flow. Okay, so when they say minus initial investment, you also need to know that that investment you are doing, there are times that you start a business with 300 million, okay, at day one, you imputed 300 million into that business. But as a business continue to progress, you have to keep injecting more funds. So those funds that you are injecting into it, they are happening at different times of the project life. So you discover that we cannot just say initial investment because that sounds too common. Because those investments you are doing, they are cash flows that you are injecting into the business, and they are not coming at the beginning of the year. Some are going to come at a later date. So these cash flows also, you also need to discount them. So now we define it. Net present value equal to the present value of return phase cash flows. That means the money you are expecting to get from the project, the present value of that return phase cash flows minus the present value of the investment phase cash flows. The reason is because the investment phase may not be at the beginning of the year. It can be the beginning of the year, and then subsequently maybe you start putting working capital into the project and so on and so forth. And then I say that there are three variables to consider when calculating NPV. Three things you must consider. The first one is the number of years of the project. How many years is the project going to last? You must take it into consideration. I think every question will give you that number of years. The number two, we now talk about relevant cash flows. Now, it's not all cash flows that are important. Okay, and then when we get there, we understand why they have to put this word relevant, because not all cash flows. We know that cash flows are in two stages. The first one is the investment phase cash flows, and we also talk about the return phase cash flows. So you discover that most times is this investment phase cash flows that gives students problem, because they now start asking themselves, okay, which of the cash flows am I going to consider? Which of the cash flows am I going to consider? So you need to know the relevant cash flows that is needed for the computation. Then the next one, we also talk about appropriate discount factor. Appropriate discount factor. Now, it's not all discount factors that are appropriate for your project, because the examiner will test you. There are a lot of things that they consider when doing NPV. They test your knowledge of taxation. They test your knowledge of inflation. They test your knowledge on different areas, even cash flows. There are different ways in which you need to do all those things. So that is why you need to be very knowledgeable in this topic. And this topic, once you know it, you discover that you keep finding it at different stages of your SFM. They also tell us that cost of capital is like the debit and credit of SFM. Also, I want to tell you categorically that if you don't know NPV, there are many topics that you will not be able to solve in SFM. Even if you understand cost of capital from A to Z, if you don't know NPV very well, there are many questions you won't be able to solve in your exam. So it's very important that we take note of that. NPV is very important. So now we look at what we call the relevant cash flows. I've told us about it. Okay. Then we now also talk about appropriate discount factor. So that is the cost of capital. Now, what is the decision rule? What happens when you are calculating NPV? How do you know whether the NPV of your project is worthwhile? How do you know when to reject an NPV? How do you know when to accept an NPV? Now, they say if your NPV is positive, okay, if your NPV is positive, then the cash flows from the investment will yield a return in excess of the cost of capital. And so the project should be undertaken. Now, in order for us to understand this statement, because many students in the exam, they may know how to calculate NPV, but if they don't know whether or not they can, somebody said he can't hear me. Please, can somebody let me know if you can hear me? Can you hear me, please? Hello? Yeah, they can hear me. Thank you. Somebody just jump on the group that they can't hear me, so I need to confirm. Okay, so now the decision rule is that if your NPV is positive, then you accept the project. Now, what makes us what is the yardstick behind it? They cannot just tell you on the face value that if an NPV is positive, accept it. But you need to ask question, why am I accepting it if it's positive? What is the implication on the business? Okay, now there's something they call the return phase, the returns, okay, from the project, okay, the returns from the project. Now, when you look at the next topic here that we're going to look at is what we call internal rate of returns. So this internal rate of return is that returns that make the NPV equal to 0. Okay, is that rate of returns that make the NPV equal to 0. If you are going to the bank now, you want to embark on a project and you need money, and you tell the bank that, please, I want to borrow 50 million, and the bank is giving you their interest rate. They say, okay, our cost of capital is 20%. But you as a finance manager, you need to also calculate your own internal rate of returns. You need to calculate what we call your own internal rate of return. Now, this rate of return is telling you the highest interest rate you have to collect that loan. What's it called? The bank is telling you that they are going to give you the loan for 20%. But you as a finance manager, you cannot just tell the management that this bank is saying they will give us 25%. The other one is saying it will give us 30. This one is saying it will give us 20. So let us just go for the lowest one. No, that is not how to behave. As a finance manager, you need to now calculate your own. What is the highest interest rate that we can pay for this project? Okay, in order for us to break through in this project, we cannot just go and collect money and then the money we are going to be making loss and all those things. You must calculate your internal rate of return. What is that internal rate of return that we make the project to break even? That means no matter what happens, come rains, comes sunshine, you cannot pay an interest rate that is above your internal rate of return. The highest you can pay is that internal rate of return. At the internal rate of return, you are not making loss and you are not making profit. You are going to break even. So now when we now come here, they say that at internal rate of return, your NPV is equal to 0. When your NPV is equal to 0, that means you are not making profit, you are neither making a loss. So you now come here. Now, you now see that they say when your NPV is positive, where is that place? Okay, down here. So they now say decision rule. When your NPV is positive, okay, they say accept the project. Why? Because your NPV right here, at this moment, your IRR, the highest rates of returns or the highest cost of capital that you can use for that project, we make your NPV to be 0. But when your NPV is positive, that means you are taking a cost of capital that is lower than the IRR. You have taken a cost of capital that is lower than the IRR, because at the IRR level, your NPV is going to be 0. Now, maybe we have now calculated our IRR. we now discover that, okay, for us to break through in this project, we cannot take a cost of capital that is above 25%. Now you now check, okay, this bank is giving us for 30%, the other one is giving us for 50%, the other one is giving us for 20%. Okay, you now say, okay, after we've done our findings, we now say the highest cost of capital that we can use for this project is 25% based on our IRR. So therefore, in order for us to now make profit, we will not take a cost of capital that is below the what's it called? That is below the IRR. So when your NPV is positive, it means that the cost of capital that you are using for that project at that particular time, the cost of capital you are using is lower than the IRR. Please, somebody should unmute and tell me if he or she understands this concept. Do you understand it?
Yes, sir.
Okay, so that's that. So at that stage, it means that the cost of capital that we later use is lower than the cost of capital that we use is lower than the IRR. Okay, so all right. So that is that. Now the next one, the next decision, they say if your NPV is negative, if your NPV is negative, what does it mean? It means that if you have done your project using the IRR, you would have not been in negative. Your NPV would have been in zero. It means here that the cost of capital that you are using for that project, the cost of capital you are using for that project is higher than the IRR. Because at the IRR level, your NPV is supposed to be zero. Now, if your NPV is not zero, is now negative, it means that the cost of capital you are using for that project is rather higher than your IRR, your internal rate of return. So when your NPV is negative, they tell you that you should reject the project because at this stage you are going to be making a loss from the project. You are not going to make a profit. You are going to make a loss. That is that. So if your NPV is negative, kindly reject the project. Then the last one, if your NPV is equal to zero, then the cash inflows from the investment will yield a returns which is exactly the same as the cost of capital. So the company should be indifferent between undertaking and not undertaking the project. So this is what I've explained here. When your NPV is positive, you are making a profit. Okay. Therefore, since you are making a profit, you should accept the project. When your NPV is positive, at that rate, the cost of capital that you use for the project is lower than your IRR. So this is your return. Your returns is greater than your cost of capital. Now, when your NPV is in negative, you are going to be making a loss. And then the decision is that you need to reject the project. Reject it. Why? Because the cost of capital you are using for that project is a cost of capital that is higher than your internal rate of returns. So you need to reject the project. However, when your NPV is equal to zero, that means that you are not going to make a loss. You are not going to make a profit. You are only going to break even. Therefore, you should be indifferent about accepting or rejecting the project because at this stage, your returns from the project is going to be equal to your cost of capital. So at that stage, you are neither making a profit, you are neither making a loss. So if you understand it, this is just the introduction to NPV. We will now go and now look at how to identify our relevant cash flows, how to look at the appropriate discount factor, and how to look at other things that are important for the NPV. Okay, so let's continue. Let's quickly look at others. We have done NPV. We have done the introduction to NPV. So let's go and look at internal rate of returns quickly. So for your internal rate of returns, they call it economic rate of returns or internal rate of return. Internal rate of returns is that discount rate which gives a net present value of zero, just like I've explained before. Alternatively, the IRR can be described as the maximum cost of capital that can be applied to finance a project without causing harm to the shareholders. Okay, without causing harm to the shareholder. Okay, so that is that. Now, without causing harm to the shareholder. Now, the next one we are looking at is, it is sometimes called the yield of the yield. At times it's called it's called the discounting factor yield, or internal yield, or discounted rate of return. So anyone the examiner is bringing to you, you need to know how to answer it. Okay, you need to know that they are referring to that. All right, so let's now look at it. The next one, we're now looking at how to calculate this IRR. Okay, we always use formula. Now, the IRR is found approximately using interpolation. This is giving us IRR is equal to the lower rate cost of capital, the cost of capital that you use for the project. If you are picking a lower rate cost of capital, okay, maybe a bank is saying is giving you 20%, and that one is saying is giving you 30%. Okay, so you need to take that 20% that one bank say will give you the loan, take it as a lower rate plus the NPV that you got from using that lower rate. Okay, so the NPV that you got from the lower rate, you now divide it by NPV of the lower rate minus NPV of the higher rate. You know, I gave us an example now. If a bank says giving you the loan for 20%, and that bank says giving you for 30%, the 20% is the lower rate, while the 30% is the higher rate. So you just input it in your formula. Just say, okay, 20% plus NPV of the lower rate, NPV that you got using the lower rate to discount those cash flows. You know, cash flows, they say NPV is the present value of the returns phase cash flows minus the present value of the investment phase cash flows. So when you have gotten those cash flows together, you need to now discount it to present value. So you are going to take the NPV of the returns phase cash flows. That means that you've discounted it to present value. Then you now minus NPV of the returns phase cash flows. Sorry, the investment phase cash flows. So when you now do that, this is what you're going to get. You're going to get, but to get the present value, you discounted it with a cost of capital. That cost of capital you are using for that lower, for that you use when you use this 20%, you put that NPV here. Okay, you now divide it by NPV that you got from the lower rate minus NPV of the higher rate. Okay, you now multiply everything by higher rate minus lower rate. Now, so that is that. Now let's look at this one now. L equals to lower rate, let's say like 10% example. Then H equals to higher rate, let's say 15%. Now the NPV of the lower rate, we are assuming that it is 190. Okay, and the NPV of the higher rate, we assume that it is 65%. So if I go to impute that into the formula, we now say to get our IRR equal to the lower rate percentage, which is 10%, okay, plus the NPV that you got from the lower rate, okay, which is the NPV that you got from the lower rate is 190, okay, divided by NPV that you got from the lower rate minus NPV that you got using the higher rate. When you check it, then you now multiply it by the higher rate percentage minus the lower rate percentage. When you do that mathematically, you have 17.6%. So what this means is that for you to do that project, okay, and break even, the highest cost of capital you can use is 17.6%. 17.6% is the highest cost of capital that you can use. Okay, so now since the highest is 17.6%, you now check a bank, one of the bank is giving us 10%. Okay, another bank is giving us 15%. So it's at this point now that you can now decide that, okay, if I truly accept 10%, I am going to be making a lot of profit. Okay, so it's at that point that you can now vouch that, okay, if I am accepting the lower rate, I'm going to be making a lot of profit. You remember I've already told us that when you check your IRR is the maximum cost of capital that you can use for that project. If you take any cost of capital that is above this IRR, you're going to be making a loss, because at that point, your NPV will no longer be equal to 0. Your NPV will now be giving you negative, because you are taking a cost of capital that is above the internal rate of returns. Okay, but this cost of capital that they give us here, one is 10%, the other one is 15%. So any of this cost of capital that we use for this project, we are going to make profits. However, also note that in order to make more gain, it's better to use a cost of capital that is even lower to this one. So I think this is the best. You can take 10% and discover that you're going to make a lot of profit from that project. Now, what is the decision rule when it comes to IRR? Now, if the expected IRR, okay, that you calculated exceed the cost of capital, okay, when it exceeds, that means that if your IRR is higher than the cost of capital you are using, you know, I told you that the IRR should be the maximum cost of capital that you have to use for any project. But if the IRR you are using, okay, the IRR you got is higher than the cost of capital options that they gave you. For instance, in this question, we assume that the lower rate cost of capital is 10%, okay? Then the higher rate cost of capital is 15%. So any of them that you use for this project, you are going to make profit because the maximum cost of capital that you're going to take for the project, it is 17.6%. Can somebody unmute and let me know if they are following? Do we have any question? Hello? Okay, no question from your end. So that means you understood everything. All right. Okay. All right. So let's continue. Let's continue. Yeah. Let's continue. Right. So we are done with that. So the decision rule now is what we have here. If your IRR is greater than your cost of capital, they say you should accept the project. Why? Because your NPV is going to be positive at that particular point. However, if your IRR is lower than your cost of capital, that means that your NPV is going to be negative. You have to reject the project. Okay. So that is the decision rule. So probably when we start solving questions or people that are just joining, we should go back to the beginning of the lecture, you'll be able to understand more what I've explained so far. Now let's now go to the next one. After we look at, we're just looking them briefly before we now take them one after the other. So we've looked at net present value. We've looked at internal rate of return. The next one we have discounted payback period. So yeah, let's look at it now. Where is it? Okay, discounted payback period. So in your question, examiner will give you a targeted payback period. You can say you borrow a loan that is up to 50 million, for instance. So this loan that you borrow for 50 million, the bank expects that you should pay it in the next 10 years. Okay, so you now ask yourself, what is the highest time I can pay back this loan if I invest this money into this business? Okay, so you now do it, you solve it as a finance manager to know the highest time it will take you to return the money that you collected from the bank. Okay, so that is where discounted payback period comes in. They say that it is the length of time the present values of cash flows from an investment recovers the original cash outlay required by the investment. Though discounted payback method, the normal payback period problem of time value of money is resolved. Now, I told you that anything that involves cash flows, okay, those cash flows are coming in the future time. You cannot say you will not discount them. To know their value today, you need to discount them back to present value. Okay, you need to discount them back to present value. So whenever you are doing discounted payback period, you already know the project you want to invest your money in. You go to the bank, you tell the bank, please borrow me 50 million. The bank will now say, this 50 million we are borrowing you, the maximum time you must pay back this loan is, let's say, 10 years. So you now go back home and say, okay, if I collect this 50 million, will I be able to pay it back within this 10-year period? You now do your calculation. So your discounted payback period will tell you the numbers of time or the numbers of years this investment you are trying to embark on, the numbers of years if you take this investment to generate that money to pay back that loan. So if the bank is saying pay us in the next 10 years, and then you now calculate your own your investment, and you discover that the future inflows that you get from that project will not be able to settle that loan within that 10 years, then you have to reject the project, because they're going to give you a target period. The bank is going to give you a target discounted payback period, maybe 10 years. So you, when you now calculate your own, you now compare it. If your discounted payback period is lower than the targeted payback period, then you should accept the project, or accept the project, yes, because you want to invest that money. You are asking yourself, which of the projects can I invest this 50 million? The 50 million, they are saying I should pay it back within the next 10 years. Okay, which of these projects can I invest it in? You now say, okay, this one, if I invest in this one may take me 12 years to pay back. So I'm not doing this project. If I invest in this other project, it may take me like 15 years to pay back. I'm not investing in this one. But if I invest in this one, okay, maybe it take me like 8 years. Okay, let me invest in this project. So once it get to that 8 years, once I finish paying back the loan, the remaining money from the project is mine. So that is how we work with discounted payback period. Does anybody have any question? Any observation? Any observation? Hello, are we still together?
Yes, please.
Okay, so let's continue now. So now we are now going back to MPV now. Now for that MPV, I told us that for MPV, I told us that for MPV, there are three things that you should take note of. There are three things that you should take note of when you are dealing with MPV. Number one is the numbers of years of that of the numbers of years that they are going to give you in the question. So this is it. So the three things to take note of is the numbers of years, okay? The numbers of years. Number two, we're also talking about the relevant cash flows, okay? Number three, we're also talking about the appropriate discount factors. So now for the numbers of years, you have no problem with that. They will give you in the question. But for relevant cash flows, you need to know what are the cash flows that are relevant for this project. Because remember, whenever you are doing MPV, you are taking the present value of the return phase cash flows, the money you are expected to get from the project. Okay, maybe when I do this project, I'm going to get 2 million in year one. I'm going to get 3 million at the end of year two. I'm going to get 4 million at the end of year three. So you need to discount those present value. Sorry, you need to discount those cash flows, okay, that are in the return phase. You need to discount them to present value. You're going to use a discount factor for it. Also, you whatever you get, you now minus the present value of the investment phase cash flows. Now, this investment phase cash flows now is what usually gives to them problem. They don't know the cash flows that they should take. Okay, that is where they are telling that the relevant cash flows for the project is what you need to use whenever you are doing MPV. So then the next thing we are also going to look at, they say, is appropriate discount factor. Appropriate discount factor. So let's go down and see what they are saying when we talk about relevant cash flows. What are the cash flows that is relevant to the project we are doing? Number one, a relevant cash flow is a future cash flows, okay, arising as a result of a decision. Okay, so that's the definition. A relevant cash flow is a future cash flow arising as a result of a decision. The cash flows that should be included are those specifically generated or incurred as a result of the accepting or non-accepting of the project. Okay, so the cash flows that are specific to those that are specifically generated or incurred as a result of accepting or not accepting the project. So let's look at them now. The first one, relevant. Relevant cash flow should be judged on the basis of number one, incremental. incremental. So for that cash flow to be relevant to the project, the cash flow must be an incremental cash flow. What do we mean by incremental cash flow? Let's say you have a warehouse that you are using naturally, okay? Then you now got a contract that you should come and make army uniform, okay? Now you now discover that for me to make this army uniform, I might need to get sewing machine. I might need space, okay? So you now decide that instead of me to use my 2 bedroom warehouse, I need to expand from 2 bedroom. Maybe I need to now expand into like 4 bedroom, 4 bedroom. You discover that that cash flow is incremental because of the project you are doing. So any cash flow that is incremental is relevant to the project. It's because of the project that you have to expand your warehouse because of the project. But if during that project you don't have need to increase your warehouse, then the cost of paying that rent of that warehouse is not relevant. It's because if because of the project you got or the contract you got, you had to expand your space, the warehouse space. That means that incremental cash flows, it's an outflow. It's an outflow. You have to pay more money for them to give you a bigger space. So any cash flow that you are going to consider for the project should be a cash flow that is incremental. How do we talk about cash flow? I told you that we have two type of cash flows. We have the returns phase cash flows. Those are the earnings you need to get from the investment. Then we have the investment phase cash flows. So those investment phase cash flows, they have to be incremental. It has to increase because you are trying to undertake that project. That is number one. Number two, avoidable cash flows. Avoidable cash flows. I also gave us an example yesterday. I said, if a student should call me and say, Mr. Johnson, please come and take us on the island. Okay. Then I'll say, okay, what is the cost of transportation to the island? Because I don't have a business in the island. Okay. Then I say, okay, what is the cost of transportation to get to island? Maybe I calculated, I say it's 5,000. If I'm going to give that student the cost of my service, I have to add that transportation to it. Why? Because naturally, I don't have a business on the island. Okay, so that cash flows, that 5,000 that I'm going to use for transportation is very, very important to the decision making. It's very important to the decision making. Sorry. So it's very important to the decision making. Okay. So now, how does it now become avoidable? Okay. How does it become avoidable? If I decide not to take that offer, do I need to pay that 5,000 for transport? Can somebody answer that question? If I decide not to take that offer, will I need to pay that 5,000 naira as transport fare? Can somebody answer that question? Hello. If I should decide that I am not taking that offer, I told you that a student is asking me to come and take them on the island, okay? And I now say, okay, what is the cost of transportation? I have to factor it in to the cost of my service. However, if I decide that I'm not going to go and teach that student, will I still pay that 5,000? Can somebody tell me? Are we here? Please unmute. I'm trying to explain something.
So,
Okay.
from now understand, you said if you were supposed to go to the island, you have whether the student called you or not, you would have incurred that cost. So even when the student call you and you now go and teach them, so you don't need to add that cost irrelevant. So whether you teach them or not, you would have incurred that cost.
Okay. So what I said You know, I know that you are answering based on the lecture we had yesterday. But now I'm painting another scenario. I've not mentioned that I have business in the island. I'm just telling you that I don't have any business on the island. Somebody just called me that I can come and take them. And I asked the person, okay, what is your location? The person say is on the island. Okay, and I'll say, okay, if I'm going to come to the island, okay, I'm going to incur 5,000. So I can either accept that offer or not accept the offer. If I'm accepting the offer, I'll pay 5,000. If I don't accept the offer, I won't pay 5,000 on transportation. So that is how the cash flow become avoidable. However, in a situation whereby the examiner says that naturally you go to the island every Saturday or every weekend, okay? If the examiner is saying naturally you normally go to the island every weekend, and a student calls you from the island and say, come and take us on the island, they will not ask you, the transportation fare, which is 5,000 that you're going to use to the island, is it relevant to this your decision? Because you normally go to the island naturally on weekend, and the student wants you to come and take him on weekend. So that 5,000 naira, whether you accept the project or you don't accept the project, you will still pay it. So that kind of 5,000 naira is not relevant to the project. So it's not relevant for you making decision on the project. So that is what you should understand. Okay, avoidable. It becomes avoidable when naturally you have no business going to the island. Okay, so if you decide to accept the project, you pay 5,000 naira on transportation. If you don't accept the project, you won't pay 5,000 naira on transportation. But in a case whereby you normally go to the island every weekend before, and then the student is asking you to come to the island that weekend to come and take him, you cannot use that 5,000 naira consultation to take decision on whether or not to take the offer. So that's what I want you to understand. So now let's now continue. The next one is opportunity cost. Now, opportunity cost is a benefit forgone. Opportunity cost is a benefit forgone. Okay. Now, what it means is that, let's say I gave us an example yesterday also, and I said, if you have a car, that car you are using it for Uber. Okay. Now, that car that you are using for Uber, let's say in a day you earn nothing less than 50,000 from that Uber, because I know it should be more than that. People make more than that from Uber. So let's say in a day you earn 50,000 from Uber. So I now called you. I say, please come and help us take some people to Ibadan. They are going to attend a wedding. Okay. Now, if you decide to go to Ibadan, you are not going to make that money from Uber. You're not going to make that money from Uber that day. So that means that it's an opportunity that is forgone. That money is forgone. If you accept that project, you will not make that money from Uber that day. So what do you do in order for you not to lose at all end? You say, okay, normally if I'm coming to Ibadan to come and take somebody charter to Ibadan, I normally collect 500,000. But because this time around, I am going to lose money when I leave today to come to Ibadan, you will now add that 50,000 that you would have made from Uber. You need to add it to the normal 200,000 that you normally charge to go to Ibadan, so that it will look as though you are in Lagos doing your Uber. It will also look as though you are also taking somebody to Ibadan. So you now add the money that you would have made in Lagos from that Uber for that day. You need to add it to the money you are going to take for taking people to Ibadan. So that's what they call opportunity cost. Do we understand it? Do we understand it?
Yeah.
All right. So let's look at the next one. I will try and be fast so that we can cover much. Okay, now the next one we look at is specific fixed costs or directly attributable fixed costs. They are fixed costs that would arise as a result of undertaking a particular activity. Most times they will tell you that fixed costs are not relevant, but specific fixed costs are relevant. specific fixed costs are relevant. For instance, let's say you have workers that are working for you, okay? Those workers, they are on your payroll. They are full-time workers. Now you discover that these full-time workers, you normally pay them salary. So, and they have to work for you from 5 to, let's say, 9 before. They have to work for you from 5 to 9. However, that day that you need them to do another work, okay, you now check. What you need to check is that, do they have idle time? That is number one. If they have idle time, maybe you need them to do another project, and that project requires that they should use 3 hours. Okay, you now ask them, okay, from 9 a.m. that they come to work to, let's say, to 9. Sorry, from 7 a.m. that they come to work, or from 9 a.m. that they come to work to 5. Do they have any idle time? You now check it. If they have idle time and they have that 3 hours idle time, then they're not going to incur any other cost, because salary is a fixed cost. You have paid them, salary. Salary is a fixed cost. So you not incur any other cost. But in a situation whereby they don't have any idle time, from 9 a.m. that they resume to office to 5 p.m. that they close, they are always engaged, busy. That means that they don't have any idle time. Then you now ask, can they do overtime? If they can do overtime, then you now need to get a fixed cost for salary, because they are doing overtime and it's not part of their normal work hour. So that is where a fixed cost will arise. Okay, specific fixed cost. And it can also be looked at from other areas. It can also be looked at from other areas. Okay. All right. So it can also be looked at from other areas. Okay, maybe you have a space, okay, just like we have the incremental cash flows. Also, you have a woman parlor that you have been managing for your business before, but because you want to do additional tasks, you have to increase the space from 2-bedroom to maybe like 4-bedroom flat. So you see that there's a specific fixed cost that you incur because you are doing that project. A fixed cost arose because you are going into that project. So that specific fixed cost is relevant. Now let's now look at irrelevant cash flows. Irrelevant cash flows are those cash flows that when you see them in the question, please don't add them. Don't use them for your MPV. Do not use them for your MPV. Example of it is depreciation. Anytime you see depreciation, don't use them for your MPV, because cash flows, MPV work with cash flows, movement of money. But a depreciation, amortization, or what do you call the other one? Impairment, whatever it is, those things, they don't involve movement of cash. They are non-cash items. They are non-cash items. So they should not be used for the project. So if they give you profit before interest and tax, okay, and then they tell you that they have deducted depreciation from that profit, you need to add back depreciation, because depreciation is not a non-cash item. You need to add it back so that you can get the true picture of the money that you have in your company. Then the next one is apportion fixed cost. Apportion fixed cost is like general fixed cost. Okay, before I took that contract, I already have 2-bedroom that I'm using for the project. Now, when I now took that contract, does it increase the money I'm paying for the 2-bedroom? No, it doesn't increase it. So, but because I say I'm paying rent for the 2-bedroom, and I say, okay, because I'm doing this project, I'm doing that project, and I say I will not share part of the rent on another project. No, it's not relevant. Apportion fixed cost is not relevant. General fixed cost is not relevant. Okay. Now the next one, interest payment. Okay. Interest payment is another thing that is not relevant. Okay. Probably you say 10% of the 50 million is the interest that you need to pay. So that 10% of 50 million, you're going to get probably like 5 million. So you cannot say because you're paying interest that the 5 million is relevant, and you now subtract it as part of the investment phase cash outflows. No, that interest payment is not relevant. So what you need to do is that interest rate payment, What is relevant is that percentage, 10%. That 10% has been added to the cost of capital. It has been added to the cost of capital. So that cost of capital you are going to use to discount this money back to present value. When you are discounting something to present value, you are removing from it. So that interest, that 10% of 50 million is going to give us 5 million. So when you add that to your cost of capital and you use it to discount the cash flows to present value, whenever you are discounting a cash flows to present value, you are taking away the effect of the interest and every other thing from it. Okay? Now, then the next one, we talk about sunk costs or past costs. Sunk cost or past cost is a cost that has been incurred, is in the past. Now, it does not affect your decision. An example is that, let's say you want to build a factory. You have to build a factory. So you need to have a land. That land, now, you need to now clear the land. Okay? Now, when you clear that land, in your mind, you say, okay, I want to build a factory. When you are trying to now get the cost of that factory, you cannot say because you clear a land that you add that the cost of clearing that land to the cost of the factory, because you can still change your mind on the fact that for the fact that you have cleared that land doesn't mean that you do factory on it. What if you now use it to do school? What if you now build church on it or anything? So that is a sunk cost or a past cost. Is not relevant for your cash flow. Then the last one is what we call notional cost. Notional cost is like opportunity cost. Okay, notional cost is like opportunity cost, and I explained it yesterday. Can somebody unmute and tell me what notional cost is? Let me know if we are following. Notional cost is like opportunity cost. Can somebody explain what notional cost is? Can you hear me? Can somebody hear me? Should I call name? Madam Franca. Christabel. Mr. Samuel. Mr. Adelari. Miss Ike. Somebody should say something. What is notional cost? Can somebody tell me what notional cost is before we move on? Do you have idea? If you don't have the idea, tell me you don't have idea, then we can move on. Hello? Okay, I'm listening. Do you have idea or you don't have idea so that we can move on? Okay, somebody doesn't have idea. Okay, let's move on. Yeah. So when you talk about notional cost, I say notional cost is like opportunity cost. I've already explained what opportunity cost is to us. Opportunity cost is an opportunity. No, opportunity cost is an is something that you forgo. Okay, is an opportunity that you forgo, or what do they call it again? I can't remember. So it's a benefit that you forgo. Okay, a benefit that is forgone. That's opportunity cost. But notional cost is just like opportunity cost. But the difference between notional cost and opportunity cost is that for opportunity cost, you are sure you know the benefit that you are foregoing. For instance, you are using your vehicle for Uber. You know that on that day you are going to make 50,000 from Uber that day. So you already know, you are sure of it. So that is the benefit that you will forego if you decide to go to Ibadan. However, under notional cost, for notional cost, is a benefit that you thought you will forego. A benefit that you thought you forgo. So let's say you have a car, okay, and then somebody now say that come to Ibadan, come and help us to carry some couples to Ibadan. They want to get wedded. Okay, you now give them the price. You say my price is, let's say normally you go to Ibadan for 200,000. Okay, Then you now say, but wait, oh, before I give these people 200,000, if I use this car for Uber in Lagos today, I would have earned, let's say, like 500,000. So you now say, okay, because of that, because it's a benefit that you thought you will forgo, but you are not. But the truth is that you have not been using that vehicle for Uber. So you now say, instead of me giving these people that my cost to go to Ibadan is 200,000, I'm going to say, if I'm going to use the same vehicle for Uber in Lagos, I should make 500,000. So, okay, therefore, I'm going to give them 500,000, or I'm going to give them 500,000 plus the 200,000, because that's how opportunity cost operates. Opportunity cost is like you add that benefit that you forgo, you add it to the original cost. For instance, if you are doing Uber in Lagos for 50,000 and you have to go to Ibadan for 200,000, you now ask yourself that if I should use this vehicle in Lagos for Uber, I will make 50,000. So in order to give them cost for the Ibadan, you add that 50,000, the benefit that you thought you forgo, add it to the 200,000 and say my money is 250. But in this case, here for notional cost is a benefit that you thought you will forgo, but in actual sense is not happening. Another example is that when you are using your building for your company, a lot of people will say, this building now, as I'm using it for my company, I should be charging rent. I need to be charging rent, because if I should rent this building out to somebody, this is the amount the person will pay. But the question is that, do you actually have anybody that is coming forward to say they want to rent the building? No. So if nobody is coming forward to say they want to rent the building, then you cannot consider it as a notional cost, okay? Or you cannot consider it as opportunity cost. So what you just do is that just say, okay, because I'm using that building for the office, I'm going to charge them, let's say, I'm going to incur rent of 500,000. But if I now say, okay, if I'm taking 100,000 for this thing now, then opportunity cost, what about the money I would have lost if somebody has come to rent that house? Maybe a standard house outside is let's say like 5 million, and then you are using that your building, you are using it for your office. You now say, if I rent this house, I would have collected 5 million. So therefore, I want to also add the 5 million to the 500,000 that I'm collecting to make it 5.5. No, it doesn't work that way. They call it a notional cost. A notional cost is not a relevant cost. Now, what is that notional cost? The notional cost is that 5 million that we say we would have rented that house to our outsider. Okay, that 5 million is not relevant. But the actual money that you decide to charge your company, that is okay, rent of 200,000. That rent is possible. You can call it rent, but you not recognize a notional cost. The notional cost is that 5 million you would have rented it out to somebody outside, but nobody outside is coming to say they want to rent. So that is what they call notional cost. Do we understand notional cost now? Can somebody unmute and tell me, do you understand notional cost now? Can you hear me?
Yes, sir, I understand now.
All right. So that is what notional cost is about. Okay. So that's what notional cost is about. Now let's now go. We are moving. The working capital now. Some capital investment involves an investment in working capital as well as fixed assets. Because as you are starting the project, probably you want to start a farm. Okay, you need tractors, you need a lot of things. So then as the project continues, you will need like to buy fertilizer, you need to buy other things as the project continues. So that is where working capital comes to play. Okay, working capital is what we call those other money you still incur during the life of that project. Okay, as you are doing the project, you first started it with a fixed asset. You bought tractor, you bought machinery, you bought this one. But as the business continues to unfold, you still need to invest more money. Probably the money that you are going to invest on fertilizer, the money you are going to invest on other things. So those things are called working capital. They are very important also when you are doing MPV. Okay, so some capital investment involves an investment of working capital as well as fixed assets. Working capital should be considered to consist of investment in stocks and debtors minus trade capitals, trade creditors. The way we normally do working capital, we say current assets minus current liability. So that is your working capital. Now, an increase in working capital reduces cash flows. So reduces cash flows. An increase in working capital will always reduce cash flows. And a reduction in working capital improves the cash flows in the year that it happens. Okay. So let's say that you have 50 million in your bank. Okay. Then they now say, okay, they need working capital. We need to buy fertilizer. So an increase in working capital will always reduce cash flows. There's a cash flow you have in your bank. Maybe you have 50 million in your bank. But because the project is still requiring additional funds, it will therefore reduce your cash flow. You know, it's called that for fertilizer, maybe you want to pay 2 million, okay? And you have 50 million in your bank. So that 50 million is going to reduce by the 2 million that you are paying. So, and then they now say that a reduction in working capital improves the cash flows in the year that it happens. By conversion, in DCF analysis, in discounting factor analysis, okay, if a project will require an investment in working capital, the investment is treated as a cash outflow at the beginning of the year in which it occurs. The working capital is eventually released or recouped at the end of the project when it becomes a cash inflow. So what they are saying is that whenever a working capital comes up, okay, it's like an outflow. You are investing more into the project, okay? So money is going out. So you always jacket it in the question. Then at the end of the year, all those working capital, probably at the beginning of the year, you at the end of year one, you put extra 50,000. End of year two, you put extra 500,000. End of year three, so all those money you are putting in, they are always in jacket. They are outflows. Then at the end of the year, when the project has yielded its returns, you have to pay back all those cash flows that you collected. So at the beginning of the year, it's going to be like an outflow. Then at the end of the year, it's going to be an inflow to the organization. Now let's now look at inflation and project appraisal. Now, inflation now is also something that you should take note of. When we are talking about inflation, then we are now going to talk about appropriate discount factor. I told us about this discount factor now, appropriate discount factor. There are some discount factor that the examiner will give you to do your calculation. But if you use that discount factor, you will not get, you fail the answer. Because examiner is expected that you should know how to calculate the relevant discount factor that should work for you. Okay, they expect that you should know how to calculate the relevant discount factor that will work for you. So now let's now see now this inflation, it increases everything. When there's inflation in the economy, it increases the prices of lending and also the decline in the value of money. So inflation is a general increase in prices, okay, leading to a general decline in the real value of money. In general, the effects are as follows. Revenue will increase. Workers will start asking for more money, and our salary is not enough. Increase our money. Then people that are selling in the market, they also increase their own costs. There's increase everywhere. Then also the people that are lending money also, we also increase their lending rate. Okay, so inflation affects everything. It affects revenue, it affects cost, it also affects discount factor. Now let's now look at how they affect our cash flow. How does inflation affect our cash flow? Now there's a cash flow that they call money term cash flow. In your question, if the examiner should tell you the cash flows are in money terms, okay, or the cash flow are in nominal terms, what they're telling you is that the cash flows has already been inflated. So the cash flows has already been inflated. Inflation has affected it. So if it's a salary, the cash flows have been inflated. That means that they've added the effect of inflation. If you are paying a worker 50,000 in year 2020, in year 2025, you can't continue to pay the worker that same 50,000. You must have factored in the effect of inflation, the time value of money. Money is no longer having value. So that salary must have also increased. So when they tell you that your cash flow is in money terms, know that that cash flow has been inflated. When they say it's in nominal terms, know that that cash flow are being inflated. Now, these are the predictions of the actual sums of money which will be received and paid, taking into account predicted inflation levels. The money rate of interest is the interest rate which is normally quoted and contains an allowance for inflation. Okay, for example, a 20% discount rate may contain an allowance, okay, for expected inflation of 5%. So now let's now see. I've already told us about cash flows. Cash flows can either be in money terms. If they say it's in money terms, it has been inflated. If they say it's in nominal terms, it has been inflated. There's another kind of cash flow. They call it real cash flow, real cash flow. So these are cash flows expressed in today's prices. A real cash flow or a real discount rate is the real required rate of returns after adjusting the money discount rate of return. So whenever you have a real cash flow, it's a cash flow that has not been affected by inflation, or it's a cash flow that you have factored out the effect of inflation. You took out inflation from it. So the money is now without inflation. So they call it real cash flow, okay? Real cash flow. Then when we talk about money cash flow, it's a cash flow that has been affected by inflation. So as we have cash flows like that, we also have discount factor. There are discount factors that has been affected by inflation. They also call them I wanted to say they are cost of capital or interest rate that has been affected by inflation. They call them money interest rate, okay? Then or nominal interest rate. So those ones have been affected by inflation. So an example is this one. Now they say if they tell you that 20% discount rate is used, okay, you must know that they must have added inflation to it. And they tell you that this 20% is the money rate or the nominal interest rate. You must know that. And they tell you that in the market, inflation is 5%. Just know that this 20% already contains 5% inflation. Okay. So now the other one also, when you talk about a real discount factor, it's a discount factor that does not contain inflation, or a money discount factor. It's a discount factor that does not contain inflation. Now, what is the relationship between cash flows and discount factor? So now they say when you have a money or nominal nominal cost of capital or discount factor, okay, you should use it to discount a nominal cash flow. When you have a nominal cost of capital, you should use it to discount a nominal cash flow. But if you have a real cost of capital, you should use that real cost of capital to discount real cash flows. Now, then after that, because inflation affects financing needs, is also likely to affect gearing, okay, and so cost of capital is also to affect gearing and cost of capital. So let's now look at that inflation now. Whenever you want to factor out the effect of inflation from the cost of capital, what do you use? There's a formula you use for it. And also when you want to factor out the effect of inflation from cash flows, there's also another formula that you also use for that. But let's therefore concentrate on for the cost of capital. If you want to factor out the effect of inflation from a cost of capital, or if you want to add the effect of inflation on a cost of capital, this is what you use. You use the Fisher's equation. Fisher's propounded an equation, okay? Now, it said that, now, for inflation cost of capital, a cost of capital that has suffered inflation, we are going to use M to represent it. So the money rate, okay? M is representing it. Now, for a cost of capital that has no inflation, we call it real cost of capital. So they are representing it by R, and therefore the inflation itself, we are representing inflation by I. So now this formula now was propounded by Fisher's. This is what we call the Fisher's equation. So this equation is saying to get the money cost of capital, okay, to get the money cost of capital, you say 1 plus M, okay. Let's assume that we don't know what M is. Let's assume that in a question we are giving the real cost of capital, and then we want to get the money cost of capital. We want to add inflation on the cost of capital. We now say 1 plus M equal to 1 plus R, open bracket, 1 plus I. R here is representing the real cost of capital, or the inflated cost of capital, and then the I is representing inflation. So once you want to do that, you can now do it mathematically. What you need to do is that since what you don't know is M, you can say M should be here. Now collect like term. This one that is here, you now move it over to this side. It now be changed from positive. It now become -1. Okay, so you can now do that mathematically, and you get your answer. You get your answer. Okay. Sorry. So you now get your answer. So you get your answer. So let's move on. Let's be fast now. So now they say note, if the cash flows are nominal, you should use a nominal cost of capital. And if the cash flows are real, use a cost of capital that is also real. Okay. So let's now look at an example. Let's look at an example. I think this is where we stopped yesterday. Okay, let's look at an example now. They say a company has a nominal cost of capital of 18%. So a nominal cost of capital. What kind of cost of capital is called the nominal cost of capital? Can somebody quickly answer that before we continue? What kind of cost of capital is called the nominal cost of capital? Do you know? Do I call names? Do I call names? Are we together? Okay, so the nominal cost of capital is a cost of capital that has been affected by inflation. So in this kind of situation, when they tell you that a company has a nominal cost of capital, is a cost of capital that has inflation. So that money, another name for nominal is money. So the money cost of capital, they say is 18%. Okay. Now, they now say if they tell you that the inflation is 6%, it means that in this 18%, the effect of inflation has been considered. So because it's a nominal cost of capital or a money cost of capital. And then in the question, let's assume the question is giving you a real cash flow. You discover that the cost of capital examiner gave you is money, is nominal cost of capital. But you don't need a nominal cost of capital when you have a real cash flow. What you need for a real cash flow is a real cost of capital. So it therefore means that you need to factor out the effects of inflation from this 18%. And how do you do that? That is where Fisher's equation comes to play. Now, using the Fisher's equation, we say 1 plus M. We already know what M is. M is given. or the nominal cost of capital is given as 18%. So it becomes 1 plus 0.18, okay, is equal to 1 plus R. What is our R? We don't know what R is because we are trying to look for the real cost of capital. Why? Because the cash flows we're given in the question, they are all in real terms. So we need to change our nominal cost of capital. We need to change it from the nominal. We need to change it to the real so that we can use real cost of capital for real cash flow. So we now say, okay, 1 plus 0.18 equal to 1 plus R. We don't know what R is. R is what we are looking for. Then we close our bracket. We now say 1 plus, what is our inflation? Our inflation is 6%. That is 6 divided by 100. We have 0.06. So we now say we are trying to get what R is. Okay. So what do? We need to collect like terms, or we need to, yes, to make this our R stay alone, we need to divide both sides by what is beside R, which is 1 plus 0.06. We divide both sides by this amount. So we now say 1.18 over 1.06 is equal to 1 plus R bracket 1.06 over 1.06. So 1.06 we cut themselves. This 1.06, yeah, the 1.006 here, we cut this one here, okay? We cut this one that is here, okay? To make R alone. So this 1.06, we cut this 1.06, then your 1 plus R will now be alone. So we now say, collect like term, we now say, we let 1 cross the equal sign so that only R will be remaining. So the 1 here now becomes a minus. So it now becomes R equals to 1.18 divided by 1.06 minus 1. The answer, when you do it mathematically, you now get what we call 11.36%. 11.36%. So this one now is what we now call the real cost of capital. The real cost of capital is 11.36%. Now, if you decide that you want to just minus this 6% from 18%, you would have gotten a wrong figure. Okay? You would have gotten a wrong figure. You would have gotten like 12%. But when you use Fisher's equation will give you the right thing to use. Fisher's equation will give you the right thing to use. So let's move on quickly. They now say that note, NPV should be calculated in money or nominal terms, and therefore the rate used should be nominal or money rate after adjusting for inflation. However, when the inflation rate is the same for all the cash flows, let me let you understand though. They say normally, okay, as a standard, NPV should always be calculated in the money and the nominal terms. So that means NPV must always be calculated with inflation. That's what they are saying. Okay, now it must always be calculated with inflation. They now say that, however, okay, where your inflation rate is the same for all cash flows, because they will give you different cash flows. They will give you different cash flows. Now, where the inflation is the same for all cash flows, then you will need to what is the word? So when the inflation rate is the same for all cash flows, we can calculate the NPV in real terms using the real rate, and both will be allowing for rounding off. So what they are saying now is that now in a situation whereby they give you in your question, okay, your question now, they say normally your MPV should always be calculated in money terms. That means that the cost of capital you have to use should be the money cost of capital, and also the cash flows that you have also should be the inflated cash flows. They now say that every time MPV should be calculated in money terms. Okay. They now say, however, if the inflation rates that they gave you, okay, for your cash flows, if the inflation rate is the same for all the cash flows that you have, probably the cash flows you have transportation, 5,000. They say the inflation rate that will affect the cash flow is so amount. They say this other one, the inflation rate that will affect is the same kind of cash flow all through. Then they say in that case, hold on. Now they say in that case, you need to make sure that you calculate your MPV. That is the only time when your MPV cannot be calculated without inflation. The only time when your MPV can be calculated without inflation is when the MPV that you are giving, when the cash flows that you are giving, they all have a inflation rate that is the same. So now they are expecting that you should use this your inflation rate to increase your cash flows. But since the cash flows has one inflation rate, then you can decide that, okay, let me not even inflate these cash flows at all. Rather than that, let me check my interest rates. My cost of capital, let me see. Is my interest rate, is it inflated? If it's inflated, then you take away inflation from your what's it called? From your cost of capital instead, so that you calculate your MPV without inflation at all. Naturally, your MPV should be calculated with inflation. But if the cash flows you are given in the question, all the cash flows, they all have only one inflation rate. That means the inflation rate is going to affect if cash flow 1. You also use the inflation to increase cash flow 2, cash flow 3. Then what you need, instead of you to do all those stress, okay? Instead of you to do all those stress, don't do that. Go to the cost of capital, check the cost of capital. Is my cost of capital inflated? If your cost of capital is inflated, simply remove the effect of inflation for your cost of capital, so that at the end of the day, you have a cash flows that you have not affected with inflation, and then you have a cost of capital that has not been affected by inflation as well. Are we together? Are we following at all?
Yes, sir.
All right. So thank you. Now let's look at another example. If you've understood what I've mentioned, in some way, I said normally MPV should be calculated with inflation. Naturally, it should be calculated with inflation. But in a case whereby MPV is not, in a case whereby you see that all the cash flows you are giving in the question, okay, they have only one inflation rate. That means that they are expecting that you should use that inflation rate to multiply all those MPV. Okay, they are expecting that you should increase the MPV by that inflation rate. But if the inflation rate is the same for all the cash flows, then instead of you stressing yourself, going to inflate all the cash flows by inflation, increase cash flow 1, cash flow 2, cash flow 3, go and check the cost of capital you have in the question. Is this cost of capital, is it inflated? If it's inflated, now because your cash flows have not been inflated, simply take away the effect of inflation from your cost of capital, so that your cost of capital will also not be inflated, as your cash flows has not been inflated. Then you can now use that for what you are trying to do. Okay, so now let's now look at another example. This example we are looking at will enable us to solidify our understanding. Now they say a project requires an outlay of 1.5 million in year 0. Okay, it requires an outlay of 1.5 million in year 0, and we will pay cash flows in real terms. That is today's price. Okay, so it will pay cash flows in real terms. Now, let's now look at it as follows. So it will create cash flows in real terms as follows. So number one, we have year 1 is going to get like a 670,000. Okay, year 2 you're going to get 500,000. Year 3 is going to get 1,200,000. Now they now say the company's money cost of capital is 15.5%. Okay, now the company cost of capital is 15.5%. Now remember, taking note of what we've said, let's look at the requirement. Appraise the project if inflation is estimated to remain at 5%. So the inflation rate we are giving in this question is 5%. Okay, so if the inflation is expected to remain at 5%, what are you to do? We are trying to solidify that knowledge I gave us. I told us that number one, normally MPV should be calculated in money terms, or you should always have a MPV that has been inflated, that inflation has affected. That is normal. That means that whenever you are doing an MPV that is inflated, you are taking a cost of capital that is inflated, you are using to discount a cash flows that is also inflated. So you now get your inflated MPV. However, they now told us that, however, that is the normal thing that is expected. They now say, however, if you have cash flows and all those cash flows, they have not been inflated yet, then they now give you the inflation rate, and they are expecting you to use this inflation rate to increase or to inflate the cash flows. You should now check the inflation. The inflation, does this inflation, is it only one inflation rate? They say yes, 5%. But if they give you different inflation, maybe they say cash flows in year 1 should be inflated by 5%. Cash flow in year 2 should be inflated by 6%. Cash flow in year 3 should be inflated by 7%. That means that the inflation rate is not the same. But in a case where for all the cash flows, they are giving you only one inflation rate, which is 5% here, they say what you need to do is that you should not inflate the cash flows, because why waste your time inflating the cash flows one by one when the inflation rate is only 5%? It's not a must for you to inflate the cash flows. Go and check your cost of capital. Is your cost of capital, is it inflated? Because when you have a cash flow that does not have inflation, you are supposed to discount it by a cost of capital that also does not have inflation. So when you check it now, you now see that they say the company's money cost of capital is 15.5%. That means that this cost of capital they gave you is in money terms. That means that this cost of capital has been affected by inflation. So what you would have naturally done, okay, what you would have naturally done is you would have checked this our inflation rate that they are giving us for our cash flow. Are they giving us separate inflation rate? If they are giving you separate inflation rate, then you may need to go and inflate all your cash flows, because the inflation rate are not the same. But in a situation whereby the inflation rate are the same, then don't bother. Don't inflate your cash flows. Leave your cash flows the way it is. Then you now say, okay, since my cash flows are not inflated, then the discounting factor I must use for this cash flow that is not inflated should be a cost of capital that is not inflated also. But in this case, this cost of capital we have here is inflated. So what do? Instead of inflating our cash flows, we will now go and do only one thing, which is to take away inflation from the cost of capital. Instead of wasting time in an exam, inflating the cash flows, you can also do that if you like. If you have time, you can decide to say this cost of capital is inflated already. You can decide to go and be inflating all your cash flows and now use your cost of capital to do it. But in order not to waste time, just go and take away inflation from your cost of capital, so that at the end of the day, you have cash flows that is not inflated and you have cost of capital that is not inflated. So let's look at it now. So just set solution to this question now. So that's a solution. So we now using the efficiency equation, we now say let's take away the inflation from here instead. Since all the cash flows has one inflation rate, let's take away the inflation effect from here instead. So you now say, okay, using efficiency equation, you now say 1 plus money rate. The money rate here in the question is what? 15.5%. So 1 plus the money rate, okay, equal to 1 plus the real rate. We are looking for R, okay? We now say 1 plus inflation. We know what our inflation is. Our inflation is 5%. We don't know what the real rate will be, but we know what our money inflation, our money our money cost of capital is. So when we do it mathematically, you know, what we normally do is that let me do it here for the benefit of those that are just joining. So we now say that we now say 1 plus what is our money cost of capital? Our money cost of capital that they gave us in the question is 15.5%. So if you divide this by 100, okay, 15.5% divided by 100, what will your answer be? Can somebody tell me? Can somebody tell me? 15.5% divided by 100. Nobody is talking. No. All right. So since you're not talking, I have no choice than to answer the question myself. I'm the one asking question. I'm the one asking the question. Okay. So now when you have 15.5%, you divide 15.5 by 100, and what you are going to get, your decimal we move 2 places to the front. So come again.
0.15 times.
Okay. So it will become 0.155. So here we now have it as 0.155. You need to be pressing your calculator because in exam, you must be familiar with all these things. It's one thing to know it. Another thing is for you to be able to press your calculator during the exam. Okay, then the next one is 1 plus R. We don't know what the R is because we are looking for what R is. R is what we are looking for. We don't know what R is because we are trying to get the real cost of capital. We don't want inflation on it. So then we now say 1 plus the inflation rate is 5%. So we now say 0.055. That is our inflation rate. So once you do that, you now say, okay, you want to make the R stay alone. You want R to stay alone. So what you now do is that you now divide both sides by 1.0.5% or 1.05, or you can divide both sides by this. You divide both sides by, let me paint it so that you can see it. You divide both sides by this. Once you divide both sides by this, so it is going to give you let's see, let me underline it. Or you should know how to do that now. You collect like terms. Once you have done that, then you are going to get 1.155 over 1.05 as we have it here, okay, as we have it here, equal to 1 plus R. But let me still do it because I know some people will not be able to do this by themselves. So here will be 1.155, okay, equal to 1 plus R, close your bracket, okay, then open your bracket and say 1.155 0.05, close the bracket. Then we now divide both sides by to make R stay alone, but also be able to get what R really is, we need to divide both sides by 1.05. So we now say underline. So we now divide both sides by, so let me take it here. Yeah. So divide both sides by this. So we divide both sides by this. So once we divide both sides by this, so this one here that is printed with this, let me change it to yellow or another color. So this one and this one. So this one and this one, we cancel each other out. Okay, once this one and this one cancel each other out, then that's how we have what we have over here. So that's how we have what we have over here. So the answer at the end of the day will now become 1.1. So now, once we have gotten that, okay, we now say, let's now prepare our table to discount these cash flows to present value because we have started gradually. We have started looking at what it is. Okay. Now, here we now say that once you solve this thing mathematically, you now say R equals to 0.1 or 10%. 10%, okay? 0.1 or 10%. That is what our R is because you need to multiply it by, is it 100? Yes. 10%. 1.1. 4.1 divided by 100. Okay. So now let's now look at it. Year zero. What do we have in year zero here? In the cash flows, we have in the cash flows, a project requires an outlay of 1.5 million. So the project requires a cash outflow of 1.5 million. Okay, in year zero. So year zero we have 1.5. So since it's an outflow, remember I told us that just like the way we talk about working capital or anything outflow, it's always going out. So you jacket it. So in year zero, we have 1.5, okay, jacketed, okay, in year zero. Then in year zero, using 10% as our discount factor, okay, we now say, you know your discounting factor now, 1 plus r raised to power minus n, or 1 over 1 plus r raised to power n. So once you do that, let's do that so that we understand it. Um, let me check this one away. Okay, I'm coming over. So now, okay. All right, so let's now see. Do you know our discount factor? To discount. How many of us know how to discount?
I think distance is one, is even the one divided by one plus sorry for n.
Yeah, so that is one. That is one. So another one is you can say another one is 1 over, or let me leave the space. 1 over 1 over, it's important that we learn all these things so that it will not give us problem later. So we now say 1 plus r, 1 plus r, close bracket, raised to power n. So that's it. Or you can also use the annuity. Now, the only time when you need to use annuity is when all your cash flows are like almost the same. For instance, let's say your cash flow from year 1 to 3, they are the same figure. Let's say 670, 670, 670. Then you can use the annuity formula to do it. So if you need the annuity formula, I'll also tell you what it is. So now to discount this one now, using this is year 0 now. Anything year 0 will give you 1. Okay. So this will be 1 over 1 plus r. Our r here is 10%, okay, which is 0.1. Okay. We put it here 1 over 1 plus r. Your r here is 10%. That is 0.1. So it become 1. Let me do it like this. So it become 1 point, that is 1. Yeah, 1.1. That is 10%. Okay, so like this, you now raise it to power n. What's our n? Our n is 0. Remember, you can also raise it to power minus 0, but at the top here, we should have what we call, there should be 1 at the top here. Okay, so this is what you are going to have. So once you do that, your answer is going to become 1. So anything raised to power 0 is going to give you 1. So when you multiply this 1.5 million times 1, we also give you the same 1.5 million. Then in year 1, now here, instead of you to put 0 here, what you need to do is just change this one to 1, raised to power 1. So do we know how to get our discount factor? So it will become 1 over 1.1 raised to power 1. So that is what we have here. So raised to power 1. Then the other one will become 1 plus, this one will be raised to power, let me see, this will be raised to power, raised to power 1. So this should be in brackets. So that is that for that. So once you do that, you get your answer, and then you now use it to multiply your cash flows. So how many of us is having challenge in discount, how to discount? Is anybody having challenge in discounting? Is anybody finding challenge in discounting? So let's try and do this one again. So this here we now have 1 plus r. 1 plus r. So here we now have 1 plus r. Then the next thing we now do is that we now collect like term. Let's collect like term. So if we are collecting like term here, we now say r equal to yes 1.155 divided by divided by something minus 1. That will be like 1.05. So now what you are going to get here, here will now become equal to, the answer will now become 1.1, okay, minus 1. So that will now give you that's what will give you 0.1, or multiplied by multiplied by 1 multiplied by that is 100, multiplied by 100, or it will now become 10%. You multiply by 100. Do we understand this what we did here now? Do you understand what we did here? Can somebody tell me you understand how we were able to use the Fisher's equation? So the Fisher's equation now is used when you are trying to, it's only used for discount cost of capital. It's only used for cost of capital. Now, in this question, I already told us that normally a cost of capital or the MPV is supposed to be calculated in what's it called? It's supposed to be calculated in inflated. You're supposed to calculate your cost of capital. Sorry, you're supposed to calculate your MPV inflated. But they now say, however, if in a situation whereby a question that you see, you discover that all the cash flows that you have, they have not been inflated, but there is the inflation rate that they are giving you in the question that they expect that you should use to inflate the cash flows. Simply check these cash flows. Sorry, simply check the inflation rate. Is it only one inflation rate? If the answer is yes, then you ask yourself, why do I really need to start inflating all the cash flows one after the other when they have the same inflation rate? Instead of inflating these cash flows, why don't I leave the inflation the way it is? Sorry, why don't I leave the what's it called? Why don't I leave the sorry. So say why don't I leave the cash flows the way it is, that is not inflated? Okay, why don't I leave it like that instead of me inflating the cash flows one after the other? Since it's only one inflation rate is asked, why don't I just go and say, okay, since I have a cash flow that is not inflated, then it means that I need a cost of capital that is not inflated too. So check your question. Is your question giving you a cost of capital that is inflated? If it's yes, then simply go and take away the effect of the inflation from the cost of capital. And how do you do that? You can only do that using the Fisher's equation. The Fisher's equation says 1 plus M. M is the inflated rate, okay, equal to 1 plus R. The R is the real rate, okay, then 1 plus inflation. So just check in your question. Do I have inflation? Where is my inflation? Your inflation is 5%. Okay, that is going to be divided by 100. You divide 5 by 100, you have 0.05. Okay, so that's how we have 0.05 here. Then your R, we don't have R. We are trying to look for R. Okay, the real rate is what we're looking for. But the money terms, we know what the money terms is. The money terms, cost of capital we're giving is 15.6, sorry, 15.5%. So we divide it by 100 also, we now get 0.155. Now, the next thing is that you now say, what am I looking for? I'm actually looking for R. Okay, I'm looking for R. So what do? I need to divide both sides by what is beside R, and what is beside R is this plus 1 plus 0.05. So divide both sides by this amount. So when you divide both sides by the amount, you discover that the 1.05, we cut away 1.05 under to leave the 1 plus R alone. Then over here, you now have 1.155 divided by 1.05. Okay, so you now continue. Now you now let the one, you let this one now cross the equal sign to come and meet these people that is here. So once you do that, let's come and check where's the place. Okay, so once you do that, this one now is what I've carried to this place. Is what I've carried to this place now. Is what I've carried to this place. So is what I've carried to this place now. And I say 1.155 divided by 1.05. equal to 1 plus R. So we not collect like terms, we let R stay alone. We now have 1.155 divided by 1.05 minus 1, because if 1 should cross the equal sign, it's going to change from 1 positive, it changed to negative. It now become R equal to, we now have this one here, R equal to, we now have R equal to 1.155 divided by 1.05 minus 1. So when you take your calculator and you press 1.155 divided by 1.05, whatever your answer you get 1.1. Okay, then you minus this one from it, so it becomes 1.1 minus 1. What does it give you? It's giving you 0.1. Or if you want to make it a percentage, you multiply it by 100, it now give you 10%. Okay, so thus our real money terms can be 0.1 or 10%. So that is how we were able to get this 10% that we use on our discount table. Remember, we already have cash flows. What we are trying to do is that we are trying to calculate NPV. We already have our cash flows given, but in questions, they won't give you cash flows. You have to go and get your cash flows by yourself. You need to get relevant cash flows by yourself. So we now go now to this place. We now say, okay, our discounting factor, we can use single discounting factor. That is 1 over 1 plus R raised to power n, or 1 plus R raised to power minus n. So we now say in year 0, according to the question, they told us that the project requires an outlay of 1.5 million. So year 0, since it's an outlay, anything going out is going to be jacketed. So we now have years, we have real cash flows. Remember that these cash flows, we did not affect it with inflation. We make sure that we did not use that inflation to affect it, because the inflation rate we're giving is only 1, and we say what is the need to start inflating all the cash flows where we can quickly change the cost of capital, so that we can use that cost of capital to now marry the cash flows. So what now this is that we now say this is the real cash flow, okay, from the project, okay, because we did not use what's it called? We didn't use the inflation rate to affect it. So here we now have year 0 is an outlay. So the discounting factor is 10%. So we now put it into our formula: 1 over 1 plus R raised to power n. What is our n? Our n is year 0. Anything year 0 is always 1. Okay? Anything year 0 is always 1. So we now say, okay, applying the discount factor for it, okay, we now say our discount factor is 1. So we now say this our 1 multiplied by 1.5 million. We are going to get our present value as 1.5 million. Okay, then the next thing is that we now also say that in year 1 also, we saw the cash flows as it is in the question. We've already picked all the cash flows. We need to now discount them, okay, using the discounting factor. So year 1, we have 670 as the cash flows. So we also use the discount factor. It now becomes 1 over 1 plus R raised to power n. What's our n here in year 1? Our n is 1. So when we do that mathematically, when you say, what is that? We say, sorry, if you take your calculator, for those of you that have a scientific calculator, you can just say 1 divided by, okay, 1 divided by 1.1. What do you have? 0.9090. What you now need to do is that you now say, okay, I think I should even write out those things at the side. The discounting this. Let me write it at the side. So you now say that raised to power 1. That is, you are multiplying it by 1 time. When you're multiplying it by 1 time, it's giving you 0.9090. So in bracket here, let's put our discount factor. In this year now, what I'm going to do is that I will take this one in a little. I'll take this one in a little. So we don't want to rush it. We want you to understand it well. so that when exam come, you'll be able to get it. So here now, the discount factor that we got here in this our year one, okay, what we take 1 divided by 1.1, okay, then you now multiply it by 1. So we now say in brackets, our discount factor gave us 0.9, is it 90? Has anybody done it? 0.9090.
Yes.
Okay, so 0.9090. So then the next thing we now do, let's go to the next one. We now go to the year 2. Okay, for those of you that don't have scientific calculator, what you need to do is that year 2 now, the discount factor for year 2 is maybe 1 over 1 plus r raised to power minus 2. So what you need to do is that you now say 1 divided by 1.1, your answer, you now say 0.9090 times 0.9090. So what do you get? Can somebody tell me? 0.9090 times 0.9090. That is what it will be. So you go to 0. What? What do you call it? Hello? What do you call it?
So for year 2.
Yes, for year 2.
0.8264.
Okay. 0.8264. 0.8264. Okay. So that is what we have over there. So what you need to do, since you have gotten out the discount, this thing like that, just multiply it by the cash flow. So we just say 0.0909 multiplied by 670. So it's going to give you the answer that is going to give you the present value of the cash flow become 609.1. Okay, I told you that when you talk about interest rate, and they say that they've added interest rate to your discount factor. Discount factor always reduces a cash flow, okay, from the state it is in the future. It reduces it to the present value. You discover that the real cash flow here was 670, and over here, the answer when we apply discount factor, we got 609.1. So let's do the last year. For the last year, we now say 1 over 1.1 raised to power 3. Do that for me. 1 divided by 1.1 equal to this. Oh, sorry. 1 divided by 1.1 equal to this. We now say times 0.909 times 0.909. For those of you that don't have calculator, that's how you work on it. So what do you get? Can you tell me? 0.7 what? The other lady that is giving no answer.
0.7513.
Okay, 0.75. 0.75, sorry, 7513. Oh, 7513. Okay. So once you do that, you now use this your discount factor that you've calculated. You now use to multiply the original cash flow. So it will now reduce the cash flow to this figure that we have, 901.6. So at the end of the day, when you now add everything together, so you now say 6091 plus 413.2 plus 901.6. Then you now minus it from this amount. Okay. The answer you're going to get is you're going to get 423.9. Are we together? Are we together?
Yes, sir.
Any question, any observation? Any observation? Okay, let's move on. I assume that everybody understands. If you don't understand, you can ask question. Oh, I already told you that normally MPV that you are getting, you are supposed to use inflated cash flows and also inflated cost of capital. But they now told us that in a case whereby your, what's it called? In a case whereby the cash flows you are giving, okay, you are giving a single cash flow, and those cash flows, we are to apply the same inflation rate on them. Okay, in that case, you don't need to start wasting your time because it's only one inflation rate. But if the inflation rate that they give us is different inflation rate, then we don't have a choice. We have to apply those inflation rates on all those cash flows. But in a situation whereby the inflation rate we are giving is only one, instead of wasting time discounting these cash flows in year zero, discounting the cash, instead of wasting time inflating the cash flow in year zero, inflating the cash flow in year one, inflating the cash flow in year two, and inflating the cash flow in year three. Why not just go to the discount factor that you're giving in the question and remove the effect of inflation from it, so that your cash flow becomes a cash flow without inflation, and also your cost of capital also becomes a cash flow. It becomes a cost of capital without inflation. So that is that. So let me try attend to this person, then we can move on. All right, so moving on now. So moving on. Okay. Yeah. So moving on. So we are done with the first stage. Let's look at method 2. Let's look at method 2 now. If you are looking at method 2, you discover that in method 2, instead of you to go and do what they call that, instead of you to put, the first method, we did not inflate our cash flow. But method 2, since our discount factor is already in money terms, okay, our discount factor is already in money terms, we can also say, okay, let's go and change all our cash flows. Let's also apply the effect of inflation on our cash flow. So how do we do that? The inflation rate is 5%. This is the inflation rate, 5%. So when you want to increase something by 5%, you now say that, it's just like saying that 1.05, okay, you are trying to increase it by 5%. You say 1.05. You know that you say 5% is you divide 5 by 100, okay, it's giving you 0.5. So naturally this thing is 100%, okay. Now we want to add 5% to it. Your 5%, you divide your 5 by 100, you're not going to give you 0.5. So if you add 1 plus 0.5 together, it's going to give you this amount. So what you now need to do is that you now say, okay, in year one, anything raised to power 0 is 1. Do you remember? Hello? If you are doing for year 0 now, anything raised to power 0, because this is year 0, anything raised to power 0 is going to also give us like 1. So 1 times this 1, we also give us the same net cash flows. Okay, but here now, we want to add the effect of inflation on all these cash flows. So this is all you are going to go through. The first thing you say, increase this one by 5%. This one is already 100%. So increase it by 5%. So a way you can use to do it, you can say, okay, if you want to increase it by 5%, I'm coming. You can say, so if you want to increase it by 5%, mathematically you can say 105, okay, divided by 100 times this 670. That is what we would have done naturally. But remember, you still need to consider the effect of the years. So this is year 1. So instead of you using that method where you say, some people will just go in exam, they just say, okay, if I'm to increase something by 5%, I'll just say 105 divided by 100, okay, times this 670. I'm supposed to get 703. Okay, in the first year, you got your answer. The answer will give you 703.5. But if you get to year 2, let's see if it's going to work. So year 2 now, we now also say 105 divided by 100 multiplied by 500. Abi? So it's called that in year 2, you won't get your answer because we are also considering the years. We are going to raise it per the numbers of years. So what you need to do is that the best thing to do is use this formula. When you say 105 divided by 100, okay, your answer you get is 0.05. Now you now raise it to the power of 1. You get this answer. 0.05 raised to the power of 2. Okay, you multiply by 500, you get this answer. Then 1.2 thousand, 1.2 million, okay, multiply by 1.05 raised to the power of 3, you get this answer. So you can discover that in the first place, in the first stage, we did not need to inflate our cash flows. Instead, we took away the effect of inflation from our cost of capital. But in the second stage, okay, we are going to use our cost of capital the way it is. You can see the way it is. This is the natural way that they say cash flows should be presented. They should be presented in an inflated method. So now we now say, okay, since cash flows should be presented in an inflated method, our cost of capital has been inflated. Our cash flows now, we need to inflate it also. So to get this your 1.05, you say we want to increase this, we assume that this one is 100%. This 670, we assume that it's 100%. To increase it by 5, you need to increase it by 5, you need to add, you need to say 105 divided by 100. Okay, you need to say 105 divided by 100. Then you now get the answer that you get. Then what you now do is that you now raise it to the power of you raise it to the power of the numbers of years. You raise it to the power of the number of years. So you raise it to the power of the number of years, and then in year 1 you got this one. In year 2 you got 551.25. In year 3 you got 1389.15. So instead of so after that, you now come to your discount factor. You know your discounting factor will now change now. This one is no longer 1 point. Is this 1.1? The discount factor have changed. This cannot be 1.1 anymore. I guess I made a mistake here. This will now become 1.10%, 155. Okay, this become 1.155. Am I right? Somebody should confirm. Hello? Somebody confirm whether I'm correct. Are we together? Are you following?
You are correct, sir.
Yes, sir.
Okay.
Correct.
Okay, somebody press your calculator and give me the answer. Press calculator or give me answer. Somebody should give me answer. Oh, I made a mistake there. 5. I made a mistake in that second place. I need to correct it. So this is 5. All right. So what's the answer, please? Anybody? Does anybody have the answer I'm looking for? Or you don't know what to do? Okay. I want to assume that some people don't know what to do. Or do you know what to do? So what we need to do is that we now say, I'm coming. Let me see. All right. The two payments. I don't see it. Do you have answer for me now? Hello. Anybody?
Year one,
Okay.
0.8658.
Year one is what?
0.8658. 8658.
0.8658. Somebody else. I want to 0.8658 points anything. No. So any other person. So what you need to do for me now is that what you need to do for me. On to Z. Z. Somebody else should do number 2 for me. Somebody else. So let's be sure that everybody know how to do it. Number 2. It's like some people are not even pressing their calculator, or you don't have your calculator with you.
Yeah, 0.749.
Comment. What do you call it again?
0.7496.
I will assume that your figure are correct. 0. 0. What?
7496.
7496. So you did that. So then the next thing is that somebody else, the last one. Somebody else, the last one. So why somebody is doing that? Somebody should help me multiply this 703.5 multiplied by 0.8658. Let's see if our answer should be this amount that we have here. Also for the second one, then somebody should give me for the last year.
Yeah, 2 PV is correct. 0.7. Yeah, 1 PV is correct. So
Okay.
yeah, 3 discounting factor is 0.6490.
Yeah, 3 different factor is
0.6490.
okay. 0.6490.
6490.
Okay. So okay, that's that. All right. So this is how to do it. You can see that it is very easy to do if you understand what it entails. Now, the reason why it's straightforward like this now is because we have been given the cash flows. But what about if you are the one that needs to go and calculate your cash flows by yourself? You know, you always need the investment stage cash flows and the returns phase cash flows. So the return phase cash flow is what we call the sales. Okay, you always need those two cash flows. But in this question, the they've given us the cash flows that we should use. But the only thing they are trying to test, they are trying to test our understanding of how to use inflation. And I believe that with what we've done, majority of us we now know what to do when it comes to inflation. So we are going to look at other concepts now, because there are other concepts that also affect our cash flow. We have what we call taxation. We have a lot of things that affect our cash flow. We even have capital allowance. Capital allowance also affects our cash flow. So that's why NPV, they don't take it, it's not a joke. When you see NPV, if you can understand NPV very well, you discover that your challenge in the exam is very small. Okay? Discover that your challenge in the exam is very small. So somebody is at the waiting room. Let me just admit the person. Okay. So now let's continue. Now we now go again. We are done with this one. So you discover that whether it is inflated cash flows we use or whether it is non-inflated cash flows, your answer will be correct. Why? Because this one was not inflated. So we make sure that our discount factor also was not inflated. Now, in the next scenario, our discount factor is already inflated. So we now come here, we now say, okay, since our discount factor is inflated, we cannot use a cash flow that is not inflated. We have to inflate our cash flow also. That's why we came to inflate our cash flow by 5%. So we are now using an inflated cash flow with an inflated discount factor, okay? And then we are able to get what is here. Now, at times, okay, when you want to discount cash flows, you can see cash flows that are the same. Probably in year one, you have to pay 670. In year two, you have to pay 670. In year three, you have to pay 670. In that kind of case, what you need to do is that you need to use what they call annuity. Annuity formula is what you are going to use. When we get there, I will show you annuity. I've shown you discount factor for a single amount. That is what we have here. So individually, because the amounts are that they are distinct. So they are distinct. But in a situation whereby you have an amount, cash flows, that all of them are the same. Okay, all of them are the same. They are not distinct amounts. They are all the same as a group. They are the same figure as a group. When you want to discount those ones, you don't need to start saying year one, year two, year three. Just discount them at once using the annuity formula. We are going to get that there and I'll show you. So then I say that please note that discount rates have been computed as opposed to look up in tables to ensure that accuracy is obtained for the reconciliation. Okay, so let's now look at taxation and project appraiser. What is the effect of taxation? When you see taxation in your NPV, how do you treat it? And when you see capital allowance, how do you treat it? So the things that are important, we've looked at how to get our relevant cash flows. Okay, we've looked at that. We've also looked at how to treat inflation. Okay, how to treat inflation. We've looked at working capital. We've looked at relevant cash flow. The next thing we are going to taxation. All these things are different components that affect our NPV. Good for us here. They already gave us our cash flows. But before you get all these cash flows, you must do workings. There are some cash flows that inflation will affect. There are some taxation will affect it. You would get a place that you need to use working capital. You need to get a place you need to put cost of capital, what do they call it, capital allowance. And all these things are very important. You need to do them one after the other. That's why I took my time to break down the classes into different segments. Some people just want me to just put a past question and start solving. And people don't know how they arrive at the figure. But here we have taxation and project appraiser. How does taxation affect project appraiser? They say tax on sales profit. So you now say like tax on sales profit. We say sales minus expenses. So okay, so we now say like sales minus the variable costs in the question minus the specific fixed cost in the question. So when you do that, you are going to get your net cash flows. Then you now multiply it by the tax rate in the question. So tax is like almost straightforward. All you need to do is that first of all, get the sales or the return phase cash flows. Get the return phase cash flows from the project, then minus the investment phase cash flows. Okay, so such that we say sales minus our variable cost minus our specific fixed cost. What you will not get, you will not get what we call a net sales or a net cash flows. Then you now multiply it by the tax to get what you call tax, okay? To get what the tax that you are supposed to pay on the profit that is remaining. Because when you have your sales, you minus your variable cost, you minus your fixed cost. What is remaining is like your profit. So your profit, always know that you always pay tax on it. So to know the tax that you have to pay, just multiply it by your tax rate. Then the next one, you now say tax savings on capital allowance. Now, on capital allowance, so you now say to get your tax savings on capital allowance, calculate your capital allowance and multiply it by the tax rate. So that amount is what you are going to, it will become the tax save on the tax savings on the capital allowance. So when we get there, we'll see how to treat it, but you need to understand it first. Your capital allowance, you get it, and then you now multiply it by the tax rate. At times, they tell you in the question that you have tax allowable depreciation. If in the question, they didn't give you capital allowance, but they tell you that the tax allowable depreciation is so and so, just so that tax allowable depreciation is the same thing as your capital allowance. So pick that figure, then multiply it by your tax rate to get the amount that you are going to save on capital allowance. Now, remember that capital allowance is an allowance that is given to us in lieu of depreciation. I already told us that once we are giving our profit before interest and tax, I told us that you check, have they deducted depreciation before in the question? If they have deducted depreciation, you need to add back depreciation because depreciation is not allowed. Naturally, that figure of that depreciation is not supposed to be subjected to tax because when you minus that depreciation from the profit you have, the remaining that you have is what you charge tax on. But because depreciation is not allowed, you have to add back depreciation. But what is allowed is what we call this tax allowable depreciation. So this tax allowable depreciation is like you have to minus it from the profit. Okay, when you minus it from the profit, before you now charge your tax on that profit. But what we are doing is that we are first of all charge our tax first. So that means that we did not first of all deduct our depreciation from this net sales first. As long as we deducted our depreciation from the net sales, okay, then whatever figure we now have, we just multiply it by our tax rate to get the tax that we have to incur for that period. But here, when we got our sales and we minus our expenses, we got our profit. Immediately, we multiply it by our tax rate. I remember that before, we've already added back our depreciation because we said that depreciation is a non-cash item. But in order to still enjoy the benefits, the savings that your depreciation ought to have given you, you now use it for capital allowance. You now say, okay, tax savings on capital allowance, you now calculate it, and that is what you now use. Okay. Now, the next one, the timing of the cash flow. We also go to consider it. Now let's not look at capital allowance now. Okay. I'm going to look at examples of how to do it. Once you have done all these things in bit, then we now go straight and do a full question where everything that we have considered so far will be treated in the question. Are we together? Are we together? Are we following?
Yes, sir.
All right. So are we enjoying the class?
Yes, sir.
All right. So we are enjoying the class. Beautiful. Now let's now continue. We now go and say, okay, now this is our capital allowance. Now the capital allowances are used to reduce the taxable profit, and the consequence reduction in a tax payment should be treated as a cash savings arising from the acceptance of a project. So that is what that is saying. Um, that was that is what that is saying. So we still have we have 1 hour to go for this our class. So we should be able to cover enough. So now our capital allowance, now they say the capital allowances are used to reduce the taxable profits and the consequence reduction in a tax payment should be treated as a cash savings arising from the acceptance of a project. Now, the cash savings on capital allowance is equal to the capital allowance multiplied by the tax rate. So this is the amount that is going to be saved on tax. So we now say, okay, when the asset is eventually sold, okay, the difference between the sales proceed and the written down value amount at the time of the sales will be treated as number one. We have what we call balancing charge, okay, and we also have what we call balancing allowance. It's important in capital allowance. We already understand how to get our cash savings or capital allowance. It's just to say our capital allowance multiplied by the tax rate. But before you get your capital allowance, there are some things that you need to understand that you need to do when it comes to capital allowance. We say, number one, when the asset is eventually sold, the difference between the sales proceed, okay, and the written down amount, okay, at the time of the sales will be treated as either a balancing charge or a balancing allowance. So how does it come to play? You know, when you sell an asset, okay, that asset, you have been depreciating it in your books, okay, then the value you have in your books is what they call carrying amount. But in tax, for tax purpose, we don't call it carrying amount, we call it written down value, tax written down value. So we sell the asset. Let's say an asset that has a written down value of 500,000. Okay, we now sell it for, let's say, 6 million, or we sell it for 600,000. What we now need to do is that we need to compare this sales proceed that we sold. We need to compare it to the tax written down amount of that asset as at the time it was sold. So if the sales proceed is higher than the tax written down value of that asset, we have what we call a balancing charge. We have what we call a balancing charge, meaning that there was a profit on that sales. Then, therefore, we need to pay tax on that profit. So, a balancing charge, that means that taxable profit. If the sales proceed exceed the written down balance of that asset, you must know that there is a profit that arose on that sales. Therefore, that profit must be taxed. So we call it balancing charge, meaning that there's a profit that is still taxable that arises on that sales. However, if we reverse the case, then we have what we call a balancing allowance, which is what? A taxable loss. If the sales price is less than the written down balance. So let's now look at this question. This is a big question. In this question, we are going to be able to apply everything that we've learned so far. We are also going to go and see how to go do the taxation, okay? How to get the taxation to charge is very simple. Just take your sales minus your variable cost minus your specific fixed cost, multiply it by the tax rate, you get the tax that you need to charge. Secondly, you also go and compute your capital allowance and then multiply it by the tax rate so that you can get your tax savings on capital allowance. Then they also tell you that the timing of the cash flows is also important. Now, they also told us about the concept of balancing charge that can arise if they tell you in the question that this asset was sold at the end of the year for so amount. Must know that an issue of balancing charge or balancing allowance may come up. You understand that now? Are we together? Are we together?
Yes, sir.
Okay, so I need a volunteer. Somebody should read this question. Jato Co. Limited. A volunteer. Somebody, should I call name? Should I call name or somebody wants to volunteer? Okay. Madam Deborah, can you assist us? Okay, so example, Jatoko limit, Jatoko is considering a project, okay, whether or not to commercialize an innovative Mozu Tony device, okay, Mozu Tony device, okay, that is MTD. So now the project is that Jatoko is considering a project, and the project is considering whether or not to commercialize an innovative muscular toning device, okay, that they call it MTD, okay, that will be used in the treatment of sporting injuries. So now, when people are involved in sport, they can have muscle pull and all those things. So maybe people that are involved in sports, maybe they have injuries. So this Jatoko is now considering a project of whether or not to commercialize an innovative muscular toning device called MTD, that will be used in the treatment of sporting injuries. It is expected that the commercial life of MTD will be 4 years. So you can see that 4 years, I've highlighted it. Most times when you are doing exam, when you have a paper, just get something like a pen. So at the side here, just write a number of years, like you can just say NY, like number of years of the project, so that when you don't need to. Oh, sorry. So assuming you have your paper, okay, in bracket here, just write number of years. Just beside your paper, here, just write NY, so that you know that is where you are going to get number of years. Once you are reading, you put in where the information you need for the question is. I tell you, when solving MPV, you need 3 things. You need the numbers of years of the project, you need the relevant cash flows, and you also need the appropriate discount factor. So already we've seen the numbers of years. It's 4 years. So in your sheet, at the side of the sheet, just write NY, like an abbreviation, so that you know that is where the number of years is. You don't need to go back to that place again. If you just need the number of years, just scroll up, you see NY, just trace it. Okay, my number of years is 4 years. Okay, so they say it is expected that the commercial life of MTD will be 4 years, after which technological advancements will bring more sophisticated device to the market, and the sales of MTD will fall to virtually zero. Okay, now in this first paragraph, the only thing that we've been able to get from this first paragraph is our number of years. So your answer sheet at the side, just put dash NY, number of years. Number 2, now they now say that 8 million has been spent in developing and testing the device over the past years. Have you remember what they call sunk costs? 8 million has been spent. Anything that has been spent is a sunk cost. It's not relevant for the project. So in your book also, just put a dash and write sunk cost, so that you know that 8 million is a sunk cost. Then I say that initial market research has been conducted at the cost of 2.5 million, okay, and is due to be paid shortly. So this initial market research has been conducted at a cost of 2.5 million, okay, to be paid recently. So that also is a sunk cost. That also is anything that has been spent. Anything that has been spent, forget it, it's a sunk cost. Mrs. Ike keeps coming in and going out. Okay, so anything that has been spent is a sunk cost. Okay, so now they say that we already see that 8 million has been spent on developing and testing the device over the past years. It's a sunk cost. They also say that initial market research has been conducted at a cost of 2.5 million and is due to be paid shortly. So whether or not they pay it, it does not concern us. That one has been spent. Okay, it has been spent. Forget about it. Now, the next thing, they now say that information on future returns from the investment has been casted to be as follows. So the future, all these ones now, they are future. Future costs are, future cash flows are always relevant. Okay, they say information on future returns. Okay, that is a returns phase cash flows. So they say information on future returns for the investment has been forecasted to be as follows. So let's go. They say year 1, year 2, year 3, year 4. So we have units that was demand. Okay, unit that was demand. They demanded 20,000 for this. They demanded 20,000 for this one year, year 2. They demanded 125 in year 3. Demanded 20 in year 4. Then they also give us the sales price in unit. So sales price in unit now we have in year 1 we have 2,000. In year 2 we have 2,200. In year 3 we have 1,600. In year 4 we have 1.5. So what do you do? Whenever you are already giving unit demanded, okay, what you need to do is that to get the total sales, they are giving you your selling price. What you need to do is just say your selling price in year 1 multiplied by the total unit that was demanded in year 1. It should give you your total sales. Okay, so that is that. Then we also talk about variable cost in the current price term. So you see that they say the variable cost is in the current price term. What does it mean? Somebody should unmute. They also say fixed cost in current price term. What does it mean also? When they say something is in the current price term, let me test us. Who can give me the answer? I need answers, so give me 2 minutes. Okay, so who is answering me? When they say is in current terms, what does it mean? Somebody should quickly answer me. Now they say that if you look at this question, they say variable costs in current price term. Okay, then they also say fixed cost in current price term. Remember that all these things, they are cash flows. They are different cash flows. Okay, now they say these ones, they are in current price term. Even the selling price is in current price term. Okay, all of them are in current price term. They are all in current price term. What does it mean when they say it's in current price term? Somebody should answer me. Do I call names? Franca. Madam Ike has left. Franca, do you have an answer for me? When they say something is in current price term? Okay.
No, I don't.
Okay, Deborah, do you have an answer for me?
It
Deborah,
has not been affected by inflation.
okay, so thank you. So if you look at it, that's why when you need to pay attention to details. Any question that they give you, you need to understand each of the concepts one after the other. When they say something is in current price term, let's go up and see what current price term means, because you need to see it for yourself to know what current price term means. Let's go to that inflation. Let's go to that inflation. Somebody wants to join. Okay, I can't see the person. So when they say, okay, let's look at it now. They say, where is that place? Where is that place? Okay, where is the place? Is it inflation? So when they say that something is in real price term, I need to check. There's a place that they said it here. We have a money term, and okay, let's check. Yes, look at it. They say we cash flow now. These are cash flows expressed in today's term. You understand? So this is it. It's expressed in today's prices. Okay. So when they say current price, that is today's price now. Am I right? Hello? So look at it now. They say selling price is in current price. Is in current price term. That means it's in today's term. That means that the selling price is in real terms. That means it has not been inflated based on what we have over here. So they say these are cash flows expressed in today's prices. So that means it's in current term. That means that it's a real cash flow. It has not been affected by inflation. So remember what they also said. They said that when all the cash flows you are giving, when they are all not affected by inflation, the next thing you need to do is that now go and check your discounting factor. Is your discounting factor the same for all the cash flows? If your discounting factor is the same for all the cash flows, then don't waste your time trying to inflate all the cash flows. Okay, just go and check your I meant to say if your inflation rate is the same for all the cash flows, then don't bother to inflate the cash flows. Just go and check the discount factor and remove the effect of inflation from the discount factor so that your discount factor is now in real term. Your cash flows also are also in real term. So all these cash flows that we have here, selling price, variable cost, fixed cost, they are all in today's term. They have not been affected by inflation. However, let's now check our inflation. Is it the same for selling price? Is it the same for variable cost? Is it also the same for fixed cost? So they now say selling price inflation and fixed cost inflation are expected to be 5% per year. So selling price and fixed cost is 5%. Okay. Then they now say that variable cost inflation is expected to be 4% per year. So you see that is what started everything. Assuming all of them have only one inflation rate, we wouldn't have need to go and inflate our cash flow. We would have just only go and check our cost of capital and go and tweak our cost of capital to know whether our cost of capital is inflated or not inflated. Then also remember I told us that when you have cost of capital that has not been inflated, you need to also have a cash flows that has not been inflated. But if you have a cost of capital that has been inflated, check your cash flows also. You need to also inflate it. So in this kind of question now, since they are giving us a cash flow that has different inflation rates, what they will now do is that they will now go and give us cost of capital that does not have inflation. They will go and give us cost of capital that doesn't have inflation. Or, I think so, yes, they're going to give us cost of capital that doesn't have inflation. Or let's see, let's go on, let's check. So they say that selling price inflation and fixed cost inflation are expected to be 5% per year, and variable cost inflation is expected to be 4% per year. They now say that fixed costs represent incremental fixed production overhead. So they say that it is incremental to make us know that it is a relevant cost. Fixed cost is an incremental fixed cost, okay, which are only attributable to the project. The next one, so what you do is you're not going to check, you're not going to write in your book, in bracket, specific fixed cost, so that you know that is where the specific fixed cost is when you need it. Okay, just put specific fixed cost so that you know that that is where the fixed cost actually is. Okay, now the next one, they now say that the next one, they now say, what else did they say? Let me see, many more. All right, so they now say that the production equipment for the new device would cost 120 million and an additional initial investment of 20 million would be needed for working capital. So the working capital that is needed for this now, the first equipment, that is the fixed asset. The first equipment requires 120 million. Okay, that is the fixed asset of the project. Then they say that it will also require additional initial investment of 20 million. It will also require 20 million. Okay, and which will be needed for working capital. So yeah, you know that this is your working capital. So in your book, just put dash, just write WC to know that that is where your working capital is. Once you read the question once, you don't need to go back and read the question again. If you are highlighting those things, those important area. So here now, where we have inflation, just put at your answer sheet, just put a dash, write inflation. So that anytime you need inflation, you know where to go to immediately. When you need working capital, know where to go to immediately. So in your book, just use a pencil, just put dash and write WC, working capital. So we know that our working capital is 120 million. Okay, our WC, that is the cost of the device. That is the initial investment. That is the initial capital outlay for the project is 120 million. Then the working capital that they require for the project is 20 million. So we now continue. They now say the equipment is expected to be sold. When you are working on capital allowance, you also be mindful of whether they say the equipment will be sold. So if they say the equipment will be sold, then you need to check. You need to check what they mean by that. So if they told you that the equipment will be sold, okay, at the end of 4 years, the equipment will be sold for 10 million, okay, then when the production and sales ceases, so you know the duration of the project is already 4 years in the question, and I told you that at the bracket just write NY, number of years, okay, then over here 8 million, 2.5 million, just write at the bracket sunk cost, so that you don't need anything sunk cost for your answer. Then here, when you have selling price inflation rate of 5 and fixed cost inflation rate of 5% and variable cost inflation rate of 4%, put dash, write inflation, so that you know where your inflation is. Once you check your book, you know where inflation is. Then also you need to also check if they tell you that the cash flows, they are in today's price or in current price, they are trying to tell you that they have not been affected by inflation. All of them have not been affected by inflation. Then another thing you also now consider is that the inflation rate that they gave us, is it the same for the cash flows? If it's not the same for the cash flows, then that means that you must inflate your cash flows. Once the inflation rate they gave you is not the same, then you don't have a choice. You must inflate your cash flows using the different inflation rates that you are giving in the question. So yeah, they also told us that the production equipment for the new device will cost 120 million. This is the initial investment outlay. Then they say that, and an additional initial investment of 20 million would be needed as working capital. So working capital is 20 million. Initial outlay is 120 million. So at the side of your book, write working capital, also write initial outlay, so that when you're looking for it, you know where to go to in your question, to know where to go and find that what you're looking for. They now say that the equipment is expected to be sold at the end of 5 years for 10 million. So you also need to take note of that. The equipment will be sold for 10 million. The equipment will be sold for 10 million. Okay? So if the equipment will be sold for 10 million, if the equipment will be sold for 10 million, what does it do? We check it. We are going to compare that sales proceed. We compare it with our tax written down value as at the end of the period. Okay? We compare it with the tax written down value as at the end of the period. So we compare it with our tax written down value as at the end of this period. Okay. Then what else? What else? What else do we need to consider? Hold on, I'm coming. Uh, okay. All right. So, yeah. So we are almost there. At least most of the concepts that I've mentioned, most of the concepts we all know about it. We are getting to know most of the concepts, so that when you see any question, you're not afraid. You're just looking at, okay, what do I need to do? What do I need? What is this? What is that? What is that? You will know everything that is required in the question. So we're almost done. Once we finalize with the analysis of this question, um, then we can go on and on. Okay, so we can go on and on. Then the next thing we now do is that we now say, okay, so they already told us that the equipment is expected to be sold at the end of year 4 for 10 million. When the production and sales ceases, they also say that the average general level of inflation is expected to be 3% per year, and working capital would experience inflation at this level. So now for working capital, the inflation that working capital will experience is what we call 3%. So you can see that all the cash flows, they are experiencing different working capital. Sorry, they are experiencing different inflation rates. Working capital is experiencing 3%. Okay. Let's see, they say the average general level of inflation is expected to be 3% per year, and working capital would experience inflation of this level. Now, capital allowance is gotten as, they say, tax allowable depreciation. Okay, they say capital allowance or tax allowable depreciation on a 20% reducing balance basis. So that is the capital allowance we're giving. They give us on a 20% reducing balance basis, could be claimed on the cost of the equipment. Okay, so 20% reducing balance. So at the side of your paper, also write dash work capital allowance, or maybe like CA at the side of your book, so that you know where your capital allowance is. Then they now also say that profit tax of 30% per year will be payable 1 year in arrears. Will be payable 1 year in arrears. A balancing allowance will be claimed on the 4th year of operation. So they already told us that it's a balancing allowance that will be claimed, not a balancing charge. That means that there should be a loss in that this thing. So they say a balancing allowance will be claimed in the 4th year of operation. So they now say that Jatoko has a real cost of capital. I told you, they want to test you. They know that naturally, when you have a cash flow that is real, okay, when all the cash flows are real, they're all in real terms, they expect that when you now check your cost of capital, you now check it that also the cost of capital also is in real terms. So you want to be tempted to use this cost of capital because it's real, and then the cash flows are also real. Fine. But the next question you now ask yourself is that, what about the inflation rate? Are the inflation rate, are they the same for all the cash flows? If the inflation rate are not the same for all the cash flows, then you have no choice. I say you have no choice. You have to inflate the cash flows because they don't have the same inflation rate. So that means that this real cost of capital that they gave us is not what we are going to use. We are also going to inflate our cost of capital. The reason is because our cash flows are not having the same inflation rate. Does anybody understand what I just said? Or mute and let me know. Does anybody understand what I just said? Hello? Does anybody understand what I just said? I hope our network is fine. I hope you can see my screen. You need to tell me because I'm recording this class. Somebody on mute and tell me. Somebody on mute and let me know. Okay. So that is assumed that everything is fine. Okay. So now, so the trick of the examiner is that the examiner has given you a cash flow that is in the real terms. They have given you a cash flow that is in the real terms. And they know that as a student, you also go and be looking for a real cost of capital, which was given to you in the question. So probably what you should have just done is that just use your real cost of capital to discount the real cash flow. Since that is the rule, real cash flow should be discounted. The real cash flow should be discounted by a real cost of capital. But one thing you must now check in order not to fall for the trap of the examiner. Now check all these cash flows that you are giving. Are they having the same inflation rate? If the answer is yes, you have no issues. Just go ahead and use your real cost of capital to discount your real cash flow. But if the inflation rate that they are giving you is not the same, if it's not the same, then you have no choice. You have to inflate your cash flows. So, and yeah, in this case, working capital is having 3% inflation rate. Okay. Selling price and fixed costs, they are having 5% inflation rate. Variable cost is having 4% inflation rate. So you have no choice. You have to inflate all of them with the inflation rate. And that means that also your cost of capital, once your cash flow have been inflated, your cost of capital also must be inflated using the Fisher's equation. Okay, now required, calculate the NPV, IRR, and discounted payback period. So that is what they ask you to calculate. Calculate your NPV, calculate your IRR, and calculate your discounted payback period. So solution now. Let's have a look at the steps to follow. Number one, you need to calculate your sales, calculate your variable costs, calculate your specific fixed costs, taking into consideration inflation and deciding the appropriate discount factor to use. Though both the cash flows and the discounting factor, they are all in real terms. But the trick of the examiner is that they want to trick you. They want you to go and use it like that. But you should also now check the inflation. Is the inflation, is it the same for the cash flow? If it's the same for the cash flow, fine, you have no problem. But if it's not the same for the cash flow, then you have to go and inflate all the cash flows. And also know that once you have an inflated cash flow, you have to also inflate your cost of capital as well. Number two, once you've gotten all those variables, once you have gotten all those things, you now need to calculate what we call your cash profit. Calculate what you call your cash profit. How do you get your cash profit? By taking the sales that you've gotten, okay, after you've done all the inflation, all the multiplication of the unit price by the selling price, and you have taken all the inflation that you need to take, then you now also minus the variable cost from it. They also minus the specific fixed cost from it. Once you have taken note that they need to be inflated. Now, number two, they now say apply the tax rate on your sales profit to get your tax payable. So after you've gone the first step, you do the second step. The third step is to apply the tax rate given in the question. In the question, it tells 30%. Apply it on the sales profit to get your tax payable. The next thing is that you need to calculate your tax savings on capital allowance. Okay, how do you do that? First, get your capital allowance, then multiply it by the tax rate. Then the next one, you need to now capture your initial investment in your cash flow computation. Capture your initial investment. Your initial investment is, I think, is it 120 million. Then also capture the residual value. You know, they told us about the residual value of the stuff. We also check the residual value, tax residual value, or whatever they call it. When we get there, we see it. They also get your working capital, then, and get your net cash flows from all those things. When you have done all those, your plus and minus, you get your net cash flow. Then you now discount the net cash flows using the appropriate cost of capital to get their NPV. So remember that I told you, once the cash flows are going to be inflated, all of them, It means that your cost discounting factor also, you have to apply the efficiency equation and get the appropriate whatever you need to do. Then sum the PV together, okay, to get the net present value. Okay, sum the PV together to get the net present value. So your decision will now be when the NPV is positive, you get the profit, accept the project. When the NPV is negative, you are making a loss, reject the project. When the NPV is breaking even, then you have to be indifferent. Whether or not to carry on with it is none of anybody's business because you are neither going to make a profit nor to make a loss. Okay. Now we are almost done. We are almost done. This is the page that people should concentrate on, but people are running away. So solution now. Okay, this is solution. Solution is now we have gotten our sales, but how do we get this our sales? How do we get it? This is the solution. We are going to go and look at the workings. Remember, the first thing is that number one, you were giving the sales, you're giving the unit that was demanded. Okay, you're giving the unit that was demanded. You are also giving this sales price in the real terms. So what you need to do is that you need to inflate your selling price. Okay, when you inflate it, you now multiply it by the unit demanded to get what your sales will be for year one. Do the same for year two. Do the same for year three. Do the same for year four. So let's go and check. So we now say, okay, let's go to our workings now. Our workings. Okay, now here is it. So our selling price naturally from the question is 2,000. Year two, 2,200. Year three, 1,600. Year four, 1,500. And remember, I told us that whenever we are inflating something, we have to say 100 plus that inflation rate. Inflation rate for selling price. Let's go and check. Inflation rate for selling price and for fixed cost. I think the inflation rate for selling price and fixed cost is 5%. So when you are inflating it, you now say 100 plus 5, making it 105% over 100. Whatever you get 1.05. You now say how many years? It's just 1 year. You now raise it to power 1. When you do that, that means you are inflating this thing. This thing is 100% before. This selling price is 100% before. When you now add the effect of inflation to it, it now becomes 201,000 because you've added the effect of inflation. The next thing is that you now say, what is the unit price? The unit price here, let's go and check. The unit price is 20. Okay, the unit price is 20 or 20 because we have already put 3 zeros up. Okay, so that's why we are using 20. The unit price is going to be 20. So you now say 20 multiplied by the selling price now that we've added inflation to. When you multiply it, you get the nominal sales or the inflated sales. The inflated sales price now become 42,000 for year one. Year two, we also take our, since it's also see selling price we are still doing, it's the same inflation rate for all the selling price for all the year. Year two, we do the same. Okay, we take our unit demand for year two. Now we multiply it, we get this. Year three, we do the same. We take our unit demanded for year three. We use to multiply this, our inflated selling price, to get our inflated sales. Then year four, we also take our inflated selling price, we multiply it by the unit demanded to get our inflated sales. So you cannot take all these figures now. All these figures, you can take it to the top as sales. So when you come to the top, you can put it your sales 42 year one, 169 year two, and so on and so forth. Now, what is our variable selling price? From the question, our variable selling price is what? Our variable selling price is 900. Okay, 1,000, 1,020, 1,020. So we go again to it. Our variable, what is our inflation rate for variable cost? So we check our inflation rate for variable cost. They say our inflation rate for selling price and fixed cost is 5%. But our inflation rate for variable cost is 4%. So we go and do for variable cost now. Remember that to get your profit, you need to say sales minus variable cost minus fixed cost to get your profit. Okay, so we have done for sales. Let's now go for variable cost now. Our variable cost for year one in unit is 900. Okay, now the inflation rate is 4%. So we now say we say 100 plus 4, making it 104 divided by what is that? I'm coming. 100 plus 4, making it 104 divided by 100. Okay, once you have done that, then you now raise it to power 1 because it's in year 1. So you raise it to power 1. Then the next one, you also say for variable unit price for year 2. Okay, once you have inflated the variable cost, it now becomes 936. So you now take the unit price, use to multiply it, you now get the inflated variable cost for year 1, which is 18 million. So 18, because 3 zeros are up, 18,720,000. You also do it for year 2. Okay, you inflate it by 4%, raising it to power 2, get this amount. Okay, you also, this lady has just been okay. So let's see. So we do that for year 1, year 2, year 3, and also for year 4. Now for fixed cost now, let's go and check what is the inflation rate for fixed cost. Inflation rate for fixed cost is the same inflation rate that we are using for our sales, our selling price. So it's 5%. So we now say sales for, I think the fixed cost should be a fixed rate. Let me go and check. Where is our fixed cost again? That's why I say that you should always, okay, your fixed cost is here. So your fixed cost is in millions, okay? It's in millions per year. So now when you take away 30, okay, it's in millions. So we now go, let's go and take it and check. We now go here. Oh, sorry. So we now come over here. We now have our fixed cost, okay? Look, because 3 zeros will be up, we now have 10,000. They are all in millions. So we now have 10,000, 10,000, 10,000 because 3 zeros will be up. Then our inflation rate is 5%. We now say 105 divided by 100, we get 1.05. Waste power 1 in year 1. We inflate it, we get 10,500. In year 2, we do the same thing, we get 11,025. In year 3, remember that you are raising it to power 3. So that's why it's changing. So at the end of the day, you are not adding, you are not multiplying this one by units demanded because it's a fixed cost. You are not multiplying it by unit demanded, okay? So once you have gotten this one as your fixed cost, we can now go and check how to get our profit. So our profit, remember, is to get our sales minus our variable cost minus our fixed cost, then we get our profit. So let's quickly go and get that. So we now say year 0, year 1, year 2, year 3, year 4, then you add an extra year in case you want to recoup your working capital. So we now say, okay, in year 1, the sales, we have computed it, you put it. Year 2, the same. Then your variable cost that you calculated is a cost. So it should be in jacket. You jacket everything. Then your fixed cost that you also computed should also be in jacket. You jacket everything. Now, when you now do that, your answer will now become your cash profit. Your cash profit is what you are going to now get. Now, what is the next step? The next step is once you get your cash profit, you now get the tax that you need to pay. So look at it. Step 2, get your cash profit. Then step 3, apply the tax rate on your sales profit to get the tax payable. So in the question, our tax, we are going to be looking for it now because, okay, our tax is 30%. Naturally, in your book, in your exam booklet, you should have put dash tax to show that that is where your tax is. So it's 30%. So we now come here. We now say tax on cash profit is 30%. And they also told us something that tax will be payable on arrears. What does it mean? Where is it? They say profit tax of 30% per year will be payable 1 year in arrears. What does it mean? That the tax of year 1 will not be paid in year 1, but they will pay it at the beginning of year 2. So that's what they say arrears, okay? So they say tax will be payable in arrears. So we now say This is our cash profit now. We now say 30% of our profit in year one. We are not going to pay it in year one because instead our tax will be payable in arrears. So that answer you get, you are going to pay it in year two. So 30% of 12,780 is going to give us this amount. 30% of the profit of year two, we paid in year three. 30% of profit in year four, we paid in year three, we paid in year four. 30% of profit in year four, we will pay in year five. Okay, they are going to be in jacket. Now, the next step now, after you've gone your tax, the next thing you now do is that you now go and check what is our tax savings on capital allowance. So it means that you need to go and calculate your capital allowance. Also, remember, you also told us when the asset will be sold, that the asset will be sold at the end of year four at 10 million. Remember, they said us that. And they also told us that the asset is going to be depreciated, or the tax allowable depreciation of the asset is 25% reducing balance basis. Okay. Then they now also told us that where is the other place that they told us that there will be a balancing allowance. So they say a balancing allowance will be claimed in the fourth year of operation. So a balancing allowance occurs when you have a loss, when the sales proceed that you sell the asset is lower than the tax written down value. When it's lower than the tax written down value. So in that kind of case, you note that you need to, what's the word now? In that case, you note that you need to, you need to go and calculate your capital allowance. So let's go and check our capital allowance. How do we calculate our capital allowance? They say it is 25% reducing balance basis. So let's go and check our capital allowance now. Let's go to our workings. We are done with the workings for sales, variable costs, and fixed costs. The next one is the tax savings on capital allowance. Now, what is our asset? You know, that is the asset that we are to depreciate. Our asset is 120 million. Okay. Now, at the end of the day, the residual value, okay, is 10 million. Okay. And then they also told us that the capital allowance is 25% reducing balance basis. Let's go and confirm this our residual value. In the question, did they tell us that it's residual value? But let's check. In the question, they say 10 million. They say the equipment is expected to be sold at the end of year four for 10 million. That means this equipment now is expected to be sold at the end of the year four for 10 million. That means that at the end of year four, the equipment is supposed to have a residual value of 10 million. Okay, so that when we also sell it, that is our tax. Let's say that is what we expect that should be sold. Okay, that is our residual value. So let's now go here. Let's now check how do we calculate our cash savings on capital allowance. So we now say we already know what the initial investment is. The cost of the asset is 120 million. The residual value is 10 million. Okay, remember that 2 zeros will be up. Okay, so that's how we're doing that way. 120 million, 10 million. Then next one, we now say capital allowance is 20% on reducing balance basis. So what do? We now say our, this is it. The first year, we say 120,000 times 25%. Okay, once we do that, we get our 30,000. So that is the capital allowance. And you know that to now get your tax savings on capital allowance, okay, we've already gotten our capital allowance because it's on reducing balance. We say this multiplied by 25% is supposed to give us 30,000 as our capital allowance. Okay, so you now multiply it by the tax rate. The tax rate is 30%. So when you multiply by the tax rate, you're going to get your tax savings on capital allowance, which is going to be what? It's going to be this amount. Okay, it's going to be this amount. Okay, now the next thing you now ask yourself is that, do I need to start saying after 120 I minus 30? Okay, once I say 120 minus 30, whatever is remaining, and I'll say 25% of it, I see multiplied by 30% to get tax savings in year two. No, what you need to do is that since you know what your capital allowance is in year one, and you've multiplied it by the tax rate, and you've gotten the tax savings for year one. Okay. Now, the next year is going to be a reduced, this amount will now be reduced from 100%, will be reduced by 25%. Therefore, if it will be reduced by 25% and your tax rate is still 30%, so it means that what will be remaining is 75%. So if you use 75% to multiply 120, and then you now multiply your answer by 30%, I'm sure you will still get this amount here. So what you now do is that you now say, okay, we now take your answer for year one, okay, now put it here in year two, and you now reduce it by 70, you now multiply by 75%, meaning you have already recognized 25% before. What is remaining is 75%. So you now say the answer, the tax savings you got in year one, multiply it by 75%, we give you the tax savings in year two. Now the tax savings you get in year two, also multiply by 75% to give you the tax savings you get in year three. Also, now remember that in year four, this asset is expected to have a residual value, or is expected to be sold for 10 million. So what you now do is that you now say, okay, if this asset is going to be sold in year four for this 10 million, then how much capital allowance are we actually expected to get from this asset? So you now say 120 minus 10 million, the amount that we will sell the asset, it will now give you 110. That means the total capital allowance that you're supposed to get before you sell the asset should not exceed 33,000. Okay, so you now say what is remaining after you deduct what they expect to sell the asset in year four, because in that year where you sold the asset, you cannot start calculating whatever. So what you need to do is that you now say, okay, in year four, we are going to sell the asset for 10 million. And the original cost of the asset is this amount. So we now say this minus this residual value, whatever is remaining, is what we are now going to multiply by the tax rate to know the total tax rate that we are going to save on this asset. So the total tax rate you are going to save on it is 33,000. So what you now do is that you now say, in year one, I've gotten 9,000. In year two, I've gotten 6,750. In year three, I've gotten this amount. In year four, it will now be the difference between the total capital tax savings I'm supposed to get on the asset minus everything I've gotten before. Once you do the difference, you are going to see that you got 12,185 as your answer. So when you now add everything together, the total capital allowance or tax savings is going to be 33,000. So that is that. So now, we remember they also told us, so that is what we are going to get. Tax savings is going to be, the total is 33,000. So let's go and see. So year one is this amount, year two is this amount, year three is this amount, year four is this amount. So let's go and see whether they imputed it. Let's go and see it. Here we go. So tax savings on capital allowance. Okay, look at it. Tax savings on capital allowance. So since it's tax, you know that tax is also claimable in arrears. So that means that in year one, the savings that we made in year one is not going to be in year one because it's in arrears. So the tax will also be saved in arrears. So we now pay year this, be year this, be year this, and be year this. Okay. So kindly give me, hello everybody, can you hear me? Kindly give me 2 minutes. Okay. Now what I wanted to do is that think about how you can calculate this your capital allowance also in your own way. Okay, if you decide that you don't want to use the method I've used there, if you decide that you don't want to use my method I've used there, how else can you calculate your capital allowance and get the tax savings on capital allowance? So do this one now. Why I come back? Just give me 2 minutes. Let me quickly attend to something. So quickly work on that and let's see what you are going to get. Check another method you can use to calculate your tax savings on capital allowance. Check it. What other method can you use to calculate your tax savings on capital? Okay, so I'm back. Um, so you also need to now check how else do you need to, what other method can you use for your tax savings on capital allowance? This is the one that I used because I believe this one is pretty straightforward in the exam. If you can study it very well, if they are saying it is on reducing balance basis, just study this one very well. And anything you want to do, make sure you just do it like this. So we have 9 minutes to go to this class. For this class, we have 9 minutes to go, but let's see what we can do before the 9 minutes time. So that is how we got our cash savings on capital allowance. Now, because tax is paid in arrears, so your tax savings on capital allowance will also be claimable in arrears. So that's why we went back to this table. We now have our, where is the place? Okay, so we now have our tax savings on capital allowance. We now have it in arrears in year 2, in year 3, in year 4, in year 5. So since it's a savings, so it's going to come in as an income. Okay, so to reduce this tax rate, the tax rate here was this amount. So to reduce it, it's going to become like an income to us. So it's going to reduce our liability. Then the next one, the next thing item you are going to pick here, the capital items you're going to pick, the first one is your initial investment. In the first year, it's an outlay. The first year you take out your initial investment, which is 120 million. The next one, your residual value at the end of the year 10, okay? Your residual value is this amount, okay? This amount. So we are, because we sold the asset, and once you sold the asset, the amount is going to come in as an income. So we have this amount over here. So that is the residual value in year 4, okay? Now the next thing is that working capital now is what we need to go and look at, because working capital also has interest. Sorry, also has a, what's it called? Also has inflation rate. So they now told us here that the inflation rate, where is the place? So inflation rate for, okay, yeah, here is it. They now say the average general level of inflation is expected to be 3%, okay, per year. So that to be 3% per year. And working capital would experience inflation of this level. So they say the average general level of inflation is expected to be 3%, and working capital will experience inflation at this level. Remember, the working capital was 20 million. So let's now see, what do we do? Let's go back to the solution. Let's now go down to where the solution is. Okay, now this is the working capital now, okay? The working capital. Okay, now, with the working capital in year 0, the working capital was this amount, 20 million, right? Now, in year 1, it's going to increase by that, what's it called? It's going to increase by that 3%. Remember, so look at it here. The solution is what I've done here. So the solution is what I've done here. So we say like 3% times 20, 3% times 20 million, and that is what is giving us that figure. So 3% times 20 million, that's what gave us that figure. Now, so when you say 2% times, you have to say, now this one now, they didn't tell us year 1, year 2, year 3. They didn't tell us, just like the way we have unit price, selling price that is in year 1, year 2, different selling price. This one now is just one working capital in year 0 that they use. So that working capital is what will be increasing every year by that 3%. So let's check. I just want to be checked. I just want to confirm that we did not raise it to any power. So the first year we have what is that? 100 plus 3 divided by 100 equals to this. Then multiplied by 20, 1, 2, 3 equal to this. Okay, that is for the first year. Now, what about for the second year? For the second year, we have 103 divided by 100 times times okay times 1.03 times 20. Yeah, so it's also inflated though. It's also inflated the way it is always inflated. Year one, year two, year three, year four. It's inflated the way it used to be inflated. Then yeah, now we now see that our cash flow now, the cash flow relevant will be the incremental. So it's not all this one like that you go and put. It's not like in the first year. It's not like in the first year you are required to impute 20 million. Then the second year you are required to put 20 million 600. No, though the thing was increased by the inflation. Is that inflation element that we're going to carry into the next year? So let's see. The first year we require 20 million. The second year we are going to return this 20 million. Okay. Now, but they will not say, okay, we need for the second year we need 26 million. So they give us back the 20 million with the extra 6 million. So that means that the 20 million that we have in year one, which we already have, when we need 26 million, the company will only give us extra 6 million because they assume that we already have 20 million already from what they are giving us already. So additional that they will give us is 6 million. Then year two, like that, they will give us the incremental, because once you get to year zero, at the end of year zero, this initial outflow, you have gained it back and you have 20 million with you. And then in year one, you need addition. You need 2,600, but you already have 20 with you. So what is the difference? The addition that you need, the only addition money you need is 600. So that is the addition that they gave us here. Now, at this year, you are going to now recoup everything back. It will now become 2,600 with you. But in year two, you need 21,218, but you already have 2,600 with you. So when you now say 21,218 minus 2,600, it will give you the additional money that you need them to add to you, and so on and so forth. And then in the last year, you now recoup everything. You recoup everything. You recoup both the initial working capital plus all the additional working capital that they added to the project. And that is what is giving you 21,855. So let's go and check it quickly. 21,855. So let's go and check it. So yeah, this is the working capital now. We have the first one they need in the first year, okay? The additional ones that they need in second year, and so on and so forth. And then at the last year, they are going to regain all the working capital. So that is that. Then once you now do that, you now do it mathematically, you need to now get your net cash flows. So all these are your net cash flows. Then remember, you are supposed to go and get your discount factor. Your discount factor now, in the question you were giving, real discount factor. What is the discount factor we're giving in the question? Okay, so they say the real discount factor we're giving in the cost of capital in the question was 7.8, but we can't use 7.8 anymore because we have inflated all our cash flows. So we need to now say this is our real cost of capital. We need to also now inflate it by inflation rate. So what do we now do? We now go, let's go and see how we did that. By the inflation, we need to inflate it by the inflation rate. We now say, where is it? Yeah, so this is it now. So when I say 1 plus M equal to 1 plus R, we already know what our R is. Our R is 7.8, but we are looking for the inflated amount. So when you work it mathematically, you are going to get 10%. So that 10% you are going to use is what you are going to use for your discounting factor using your 1 plus R with power minus N. Remember all those things. So that is what you're going to use as 11% discount factor. So you now say in year zero, anything in year zero, we will give you 1. In year 2, you will do it 1 over 1 plus R with power minus N. 1 over 1 plus R with power N. You get this answer, and so on and so forth. So once you are done, you now use this. You now say this times this. You get negative amount. You say this times this, you get this amount. Okay. You also say this. You also say this times that is the net cash flows times the discount factor. You also get this amount. So that is the end. At the end of the day, you now add everything together. Add everything together, and you now get your net present value. So this your net present value is giving us $956 or naira. So you can see that this thing is positive. So because it's positive, okay, because it's positive, we now see that we need to accept the project. Decision rule: since the NPV is positive, the project is financially acceptable. The project is financially acceptable. So with this, we have come to the end of this NPV. Thank you for staying tuned. We are going to be having your SBR. Okay, your SBR is by 2:30. Sorry. So we are going to be having your SBR by 2:30. So quickly, let's ask question. If you have any question you want to ask, anybody have any question you want to ask? Hello. Please unmute your mic. Any question?
Hello, sir.
Yeah, I can hear you.
Please, the recorded version.
Okay.
I need the recorded version.
I will share. It's already, once we save it now, it will be in that our file that is already in the group. Do you
All
see
right, sir.
it will be in the already in the file? So just check the file. Once we finish the class now, once it saves, you will see there.
Okay.
Yeah.
All right, sir.
So
Then the material, this material you didn't give up.
okay, I will also share it. Also
All
share
right,
it.
sir.
Yeah. So there is this. Do we know? You know that the question is not finished. He also says you calculate your IRR, your internal rate of return.
Yes.
Okay. Can you do that? Do you know how to calculate
Yes.
internal
I
return?
can. Yes. Yes.
Okay. Do you know how to calculate discounted payback period?
I'm not sure about that one.
Okay. So what we'll do is that before the next class, which is going to be like before, I'll try and share this material on the group so that you can look at it and do IRR for me. Let me see what your answer will be. Do your IRR for me, and then we look
Okay.
at what the answer will be. So I'll share this material, and you use that one to pass time before the next class begins. Does any other person have any other question he wants to ask?
Yes, sir.
Madam Ike, Abi, is it Mr. Ike? You have been going on and off in the meeting. What's going on? Is it your network? Hello? Is it Mr. Ike or Madam Ike? I can't hear you. You have been going on and off. He has left again. Okay, so I guess probably we'll come back. But with this, we have come to the end of this class. I hope the class was very, very straightforward and very understanding. Do you understand it very well, Madam Deborah?
Yes, sir.
All right. So with this, we can call it a day, and I'll share the material. Thank you.
Thank you, sir. Thank you.